I humbly invite our members to stand up for the I Say motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनाद्यैकश्चन एतद्वैता 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 एतद्वैता.
In our culture, lighting the ceremonial lamp marks the dispelling of darkness and the spreading of wisdom. It signifies the beginning of an enlightening journey. I now invite our esteemed dignitaries to come forward for the traditional lighting of the lamp.
Good morning to everyone who's joined us today, and warm good morning and a deep sense of gratitude to both our speakers who have joined us on the stage today, Chinnsamy sir and Kamal Garg sir, and all the senior professional members here, and special thanks to Dandekar sir and Mahesh Krishnan for joining us in the lighting of the lamp. I was actually struck by a thought when we were lighting the lamp. The first light was successful by Dandekar sir, and then I struggled to light the lamp again. And then when all the faculties lit it, all it started burning bright. So, I was actually thinking how difficult it is to actually start something. No, you light a lamp to start something successfully, light a lamp to signify the beginning of, your enrichment in knowledge, power, wealth, whatever it is. And it is always a difficult process filled with a lot of obstacles. But finally, the results are going to be enjoyed by us as we put in more and more efforts. So this is also one of the endeavors of SIRC, where we want to enable members to actually listen to different perspectives from different experts who've come here to share their knowledge, as well as to, keep up with this very dynamic environment that we are in. We have so many regulators breathing over our shoulders, and sometimes you wonder, when you can get out of practice. Right? Who's looking over my shoulder? Who's going to, find a mistake in what I do? Who's going to say that, yes, you've signed this wrong, you've not put your UD in, you've not considered the accounting standards, auditing standards, but the taxation laws. But how many laws can we actually keep up with, keep track with? Okay. You have niche experts. You have an ortho surgeon to do only for bones and fractures, etc. And then you have a general physician who is going to advise you to go to someone. So we have to decide, are we really general practitioners or are we specialized practitioners? And during the course of our general observations, are we taking into account all the specialized considerations which we are supposed to take in? We have people who have successfully, specialized in many areas and who are coming and sharing their knowledge with us. And I think that, to a certain extent, provides us all with the comfort of, okay, I am going in the right path. Maybe there will be a few, ifs and buts in a few places. But as we say in Tamil, Bhagwan mela ellathiyum potittu nama sign pannidrom. But we need this assurance of sharing of knowledge from all our senior experienced faculties, and that is our endeavor in doing this, especially the company law conclave, because we know all the financial statements are going to be certified shortly. Whether it is a small company, one-person company, private limited, or a public limited company, we have so many things impacting us. And we read a lot about NAFRA, how NAFRA is overreaching arms of NAFRA, where the decisions which they take are very tough. And if you go through the NAFRA website and read the orders of NAFRA, it is actually very scary. We think, yes, we are maintaining our audit records properly, trails properly. But if you see, the people who are actually being hauled up by NAFRA have all these records. But somewhere there is something lacking, as per NAFRA's perspective. I'm not going to talk too much on that. The orders are there. If we read it, we will also be able to implement certain procedures in our own offices. What I want to say is NAFRA has all along been focusing on statutory auditors, but now they are going to move their lens onto the internal auditors, to the independent directors, and to the KMPs of corporate. Okay, so it should be a nice, rounded, holistic regulation that they are doing. So we all should not say, okay, I'm not doing the audit or stat audit of a listed company or 1,000, the top 1,000 companies. They are spreading their arms, and we should all be prepared. We should be prepared by following all the regulations, the standards, the guidance notes issued by the institute, all the other ancillary acts also which we are supposed to comply with and which we are supposed to have a knowledge of. Maybe not a thorough knowledge, but okay, some kind of a knowledge which we should have. And what is it? What is the impact which is going to be on us if we transgress anything? So for this also we are organizing a lot of programs on code of ethics and the other disciplinary actions which are initiated by the ICAI and by the other regulators. We should all be hands-on with all these. Code of ethics is something which we should all have at our fingertips. A small transgression which we may think will escape the notice may sometimes come back to bite us in a very big way. And so I will not take up too much of time from the faculties. We have already started a little late, waiting for more people to join us. We had actually invited the judiciary from NCLT to come and inaugurate this program today, but unfortunately there was some internal leave issue there, because of which they could not join us, and some protocol issues. So we are starting off without our expected chief guest. When we listen to the ICAI motto song, the first line is Ya Eshu Sukteshu Jagrati, which we normally understand as that who is awake when everybody is asleep. But actually, when I was in Vijayawada for a conference last week, one of the members corrected me and said, it does not mean that you are awake when everyone is asleep. It means that your subconscious is awake when you are asleep. But we being the professionals, we generally like to interpret everything in our own way. We say, yes, chartered accountants are awake when everybody else is asleep. Great, we are all very proud of it. But my advice is, don't always be awake. Spend some time for yourself, spend some time for your family. Relax after 7, set boundaries with all your clients. Do not let your own health or family life take a toll because you're always awake on behalf of your clients, because we as professionals, the day we join CA, immediately take our clients are our gods, and they can do whatever they want, but we will support them. Not necessary. Think whether your client is going to support you when you are in need. So that apart, what I want to say next is, please ensure, here I know everyone is very highly qualified, experienced professionals, but any which way I want to just say this, ensure that you have adequate insurance in place, use all the SME benefits which our institute has negotiated. We have also negotiated some great insurance schemes with the insurance providers. The last one which I want to talk about is the upcoming conference on August 22-23 in the Nehru Stadium. We are expecting the Chief Minister to inaugurate this along with our President and Vice President. We have a lot of very interesting sessions planned. On 23rd August, the second day, instead of the usual, the session on well-being, either by a doctor or a meditation or some religious discourse, this time we are having a play for 1.5 hours by Dummies Drama, which is a troupe again formed by a chartered accountant, and there are many chartered accountants who are acting in that play. It's supposed to be a play with some message of the comedy genre. So please everyone register for the conference, take benefit of all the technical sessions as well as this. We are also having a parallel sports event which is going to take off from July 1st among all the southern states. We are having 6 sports: cricket, tennis, shuttle, pickleball, carom, and chess. So everyone here, please do participate in the sports. We are going to have a SIRC Premier League rolling trophy going to be given, and we hope to call the Sports Minister of Tamil Nadu to actually give the trophy. And we also have another lighter event planned. This is especially for people who are traveling. Of course, people from Chennai can also take benefit. We are organizing in collaboration with the Pondicherry branch a short trip to Pondicherry, where the ashram is there and many other tourist events are available there. Pondicherry branch will enable everything. And with the Chengalpattu branch is organizing a trip to Kanchipuram, where you have temple visits as well as the silk sari and dhoti shopping, which will be done. We are negotiating some discounts at some of the premier shops there. And we are hoping to organize a darshan at Tirupati. Of course, the tickets will be limited to either 50 or 100. All this will be available on the conference website. You can all register for everything through the Google Forms, but the costs underlying in bold, costs should be borne by the members who opt for this. SIRC is not undertaking to bear the costs of anything. We are enabling everything. We'll do all the organization for you. You just have to fill in the form, and we will put you on to the people who are organizing these events. So I don't want to take up too much of time. Thank you very much, everyone, for joining us today. It is actually a reflection on the quality of the speakers and the topics. It's all there on the board. Tomorrow also we have some outstanding speakers. So hope there is a lot of benefit for all of us. Please do support SIRC in all the programs and initiatives we are doing. On 27th, we are having an MSME conclave, which is again in collaboration with the TN government. Startup TN, DPIIT and the MSME department, the FAME, DJIC, all of them are partnering with us. They are bringing in some 150 MSMEs to participate. We are giving them help desks. We are going to have MSME clinics for them. We are having some faculties who are taking some sessions on the compliances which need to be done by MSMEs. We also have bankers coming to talk to them about the schemes which are available to MSMEs. This is happening at Brahmaya Hall. So please do join us. These are all events which we are putting together to benefit both the members and the public as well. And the Tamil Nadu government, I'm very happy to say, is reaching out to us for help through various departments. Many IAS officers are reaching out to me and asking me, help us to put some systems in place, help us to understand the financial statements, help us to find chartered accountants. I like that last one, find chartered accountants. So what I went and represented to them is, yes, we'll help you put the systems in place, we'll give you the SOPs, we'll give training programs. Training programs have already been initiated by SIRC. We have an MOU with the Tamil Nadu government where for various departments we give the training. We say we'll do everything, but we'll train your people to understand the financial statements and explain to the chartered accountants what is it that you want from us. Have a panel of chartered accountants, and you can allot the work. There are more than 15,000-20,000 units within the Tamil Nadu government where they want to, some kind of professional help. Explain to the chartered accountants. They will be able to deliver what you want. What your department needs to do is understand whether the report is giving what you want and utilize the reports for whatever is the purposes that you need for your own governance purposes. This empanelment may take some time, but we've already entered into an MOU to help them to train their employees. And on 27th, we are also entering into an MOU with the MSME department, DPIT and MSME, Startup TN. Along the Central Council members are coming here. We are signing the MOU and we are taking off from there also. These are all the small informations which I wanted to share with anyone here so that you understand that at SIRC we are putting in our best to ensure that there is a lot of opportunities also which come to us as chartered accountants. It's not just that we are only conducting upskilling and updating programs and CPE programs. We also want to ensure that the government understands that once the government falls into place, then automatically the private sector and the public sector will follow the lead. That is the initiative with which at SIRC we are working, not only with the Tamil Nadu government, all other states we are trying to ensure that there are MOUs being entered into with the government and we are taking it forward. So I won't take up more time. I think this is the third time I'm telling that. So now I'm actually completing this. Thank you very much everyone for joining us. Please do join us for all the other programs. Thank you.
Thank you, ma'am, for your encouraging welcome address. So, looking into the session, we have our first session by CA Chinnsamy Ganesan sir and a second by CA Kamal Garg. So, on behalf of SIRC, to honor our dignitaries, I request CA Revati S. Raghunathan, Chairperson of SIRC, to deliver the memento to the speakers. I request CA S. Revati Raghunathan ma'am to deliver the memento to CA Kamal Garg. Thank you, ma'am. I now request CA Mahesh Krishnan sir to kindly deliver the welcome address for our esteemed speaker, CA Chinnsamy Ganesan sir.
Good morning. Shri Guru Bhyo Namaha. Respected Chairperson Revati Raghunathan, speakers of the day, CA Kamal Garg from Delhi, Chinnsamy Ganesan sir. It's my privilege to introduce to you all my guru and mentor, CA Chinnsamy Ganesan sir. But before that, let me take an opportunity to commend Chairperson on putting together this very nice program, SIRC team also, on corporate laws, which is very essential for the auditing community. Chinnsamy Ganesan sir actually needs no big introduction in Chennai. He's a Jambavan amongst all of us, an orator, a person with so much of experience in practical auditing circles and also in putting forth to the audience, chartered accountants, on the various concepts of auditing standards, accounting standards, various other subject matters also in a very lucid way. And I always used to say that he's a Rajinikanth of orators, chartered accountants, because it's like a first day, first show. People come and he's speaking. Of course, there's a Kamala Hassan, but that's for another day. I'll say who is Kamala Hassan on another day. So with this, let me quickly introduce Chinnsamy Ganesan sir to all of you. He's a person with about 36 years of experience. The first 17 years of experience he has been practicing, and then he was with Lovelock & Lewis for about 6.5 years, and then associated with BSR, KPMG for about 6-7 years. He's presently the managing partner of RKCG and Associates LLP, which was formerly known as Chinnsamy Ganesan and Company. Sir has presented about 1,450 odd papers and various seminars, workshops, and conferences, both in India and overseas, on very specialized subject matters, not general subject matters. He's also assisted about 80 odd companies in India's transition and authored several books on financial reporting and Companies Act. He brings with him a vast amount of knowledge and experience, and he's been awarded the honorary doctorate in International Financial Reporting Standards, Lifetime Achievement Award in Finance from Rotary International District 3233, and the Jewel of India Award and Certificate of Excellence for his contribution in the field of financial services. He is also an independent director in a private sector bank and also a microfinance company. He is also an independent director in Miniratna public sector undertaking under the Ministry of Railways earlier. Ganesan sir has been very closely associated with ICAI for the past 23 years and has been a guest faculty in all the 5 regional councils. He was also co-opted member of the Accounting Standards Board of ICAI, India's Implementation Committee of ICAI, and on the Auditing and Assurance Standard Boards of ICAI also. He has been a special faculty member of India's Certification Course and IFRS Implementation Committee, AASB, CPE Directorate, Committee of Members and Industry, Quality Review Board, Peer Review Board of Institute. And he has been a specialized speaker for Institute of Cost and Management Accountants of India, Company Secretaries Institute, RBI Staff College, various law colleges and universities also. With this introduction, I leave the floor to Mr. Chinnsamy, sir. Thank you.
Thank you, sir. With great respect, I now invite CA Chinnsamy Ganesan sir to commence the session.
A very good morning to all, and my sincere thanks to the chairperson of SIRC and the council members of SIRC for this opportunity of meeting. And I recognize the presence of my guru, Mr. Shankar Datta, here. And a lot of learning which has happened during my tenure under him in PwC on technical side. Thank you very much, sir, for being here. And this particular topic, computation of managerial remuneration and CSR issues. As far as the CSR issues are concerned, there is a separate session tomorrow evening, and accordingly I will not elaborate too much on the practical aspects of CSR requirements, but I will only go to the computation aspect, because the computation is little connected with section 198 computation of managerial remuneration. But we will have a detailed discussion on the managerial remuneration, related issues, and also what is the computation required with respect to the managerial remuneration aspects of the Companies Act. Section 198, Section 200, Section 197, all those things we will little bit integrate. When we talk about the key managerial personnel, because those persons who are covered as KMP are key managerial personnel, then the remuneration payable to them is covered by this particular session. That's the reason why I wanted to actually include the definition or who are all covered as part of key managerial person and what is the requirement. See, the requirement under section 203 of the Companies Act 2013 says every listed company or every other public company, but the public company should have a paid up capital of 10 crore or more, shall have whole-time key managerial personnel. So this is a basic requirement. So accordingly, you will also see that for a private limited company, there is no such requirement. It only talks about listed company and public companies who are having paid up share capital of 10 crore or more. So unlisted companies and public companies less than 10 crore of paid up capital, not net worth, paid up capital, will not get covered by this particular section. So who are the key managerial personnel who has to be mandatorily available for a listed company or a public company which is covered with the threshold limit is that should be a CEO or managing director. You can call by any name, not necessarily that every company should have a managing director. In fact, very recently we had a discussion where I am sitting in the audit committee, whether the managing director has to be mandatorily there or because there is a succession planning which we are planning. In that particular case, the managing director, if steps down, whether the person who is in the next line of activity should be immediately designated as managing director or he can be considered as CEO, and later on, after some years of experience or understudy, he can be promoted as a managing director. We had a discussion and this particular section was quoted where he can be still a CEO and need not necessarily be a managing director. And it also says a manager, but of course that concept of manager is no longer prevalent in practical sense, but the law still holds that manager category or whole-time director. The second category is company secretary and third category is chief financial officer. These are all the key managerial personnel when we were talking about 203. But what is important is the designation also matters. Suppose if you consider that there is a chartered accountant who is also a company secretary, can he hold both the designation or both the position as CFO as well as the company secretary? The answer is no, because according to the requirement of this, a person who is an independent person and a person who is the company secretary should be independent. And accordingly, there should be two persons, even though a person holds both the qualification and required experience is also available, still according to law, it requires. And there is another question which normally comes to our mind is that I have a DGM finance or a GM finance, whether that is enough. Under the Companies Act, since CFO is considered as a key management personnel, you have to designate a person. Even if you wanted to have in your hierarchy, GM is the highest hierarchy, the designation requires to have him as a CFO as well. So that is what is the requirement of KMP. And when we look at that, the chairperson cannot be the managing director or chief executive officer of the company at the same time after the commencement of the act. This is one requirement. So that means chairperson and the MD has to be two different persons, but the condition is The articles of association of such company provides otherwise. If the articles of association says that the chairman and managing director can be the same person, still it is possible. The company has to carry only one single business, not multiple business. In that case, the CMD can be one single person. Otherwise, there should be two people who has to be there. And the KMP has to hold office only in one company, except in one scenario where there is a subsidiary company. He can have the KMP role in that subsidiary company as well. And of course, with the permission of the board of directors. So then it is possible to hold it. And of course, under the Companies Act, there was a transition provision. In case if something was wrong, you can correct it. But this transition provision is irrelevant at this point in time because 2013 itself, the transitional provision was applicable. Again, coming back to this, in case if there is a vacancy in the KMP role, what the company should do is it should be filled by the board within 6 months from the date of vacation. Otherwise, it will be considered as a non-compliance under the Companies Act. In case if the company is contravening the provisions of Section 203, heavy penalty is there, 1.5 lakhs for the company, and for every director or officer of the company, it is 50,000 is the penalty. And of course, if the offence is continuing, it says for every day, 1,000 rupees of penalty is added. So accordingly, compliance with the requirement of Section 203 for a public company as well as a listed company, public company of course with the threshold limit, has to be considered with a serious compliance, as a serious compliance matter. And when we are talking about the appointment of a KMP, it says that the managing director of the company can be appointed, or whole-time director of the company can be appointed, or a manager of the company can be appointed for a term not exceeding 5 years at a time. That means you can go on reappointing them for every 5-year term. At the same time, suppose if I wanted to appoint the same MD for the next 5 years, I have to wait till the completion of 4 years of his first term, then only I can appoint, because it says that you cannot appoint for the another term before completion or before 1 year before the date of the first term's completion. So that is another thing procedurally we have to look at. Who cannot be appointed as a KMP or managing director? Age, if it is less than 21 years, or he cannot be appointed. If the age is more than 70 years, he cannot be appointed. And of course, there are certain exceptions available on this. A person who has been adjudged as an insolvent is considered as part of a person who is not eligible to be appointed. In case he has suspended payment to his creditors at any time, it says any time, or has at any time made a composition with them, even if he has gone for a settlement, then that person is also not, can be appointed. And of course, if it is convicted by a court for more than 6 months and then not eligible for getting appointed as a key management personnel. Let us come to certain frequently asked questions, certain issues which normally we face in a practical sense. Whether it is possible for a company to appoint a person who has attained the age of 70 as managerial person. Again, it says that even though the Act says 70, it's not possible. By passing a special resolution, a person having more than 70 years of age can be appointed as a key management personnel. Of course, there is no requirement for getting a central government approval for such appointment. Shareholders, if they approve it, it is perfectly all right to get appointed. Another normal question now comes is, because a lot of MNCs are coming to India and they wanted to have their representative of the global entity here as a managing director, and some other person as director or somebody here, what is the requirement in such cases? Whether a non-resident can be appointed as a managing director or whole-time director or manager of a company? The answer is still it is possible. There is no explicit statement or explicit pronouncement in the law saying that no non-resident can be appointed as a director. But the additional condition is that at least one resident director should be available for that company. If it is a public company, naturally it cannot be just two. It has its own number of directors requirement, right? So accordingly, there should be at least one resident Indian director. Apart from that, you can appoint a non-resident. There is no bar in the act as such. Coming to the next portion of our discussion, the remuneration payable to the managerial personnel. There are some sections which we have to keep in our mind, critical for the discussion. Section 197, which is actually talking about what is the overall remuneration payable to key managerial personnel. And in case the overall managerial remuneration, especially when there is inadequacy of profits or absence of profits, they are not using the word loss, but they are using the word absence of profits. What should be the maximum which a public company or a listed company can actually pay to a managerial personnel is actually coming into that. Then section 198 is talking about how you have to compute the remuneration payable to the key management personnel. In accordance with Schedule 5, read with that, how you have to compute this. And of course, section 191 and section 202, in case if you are making any payment for a director for loss of office, etc., what should be the conditions and what should be the procedures for that. Section 199 talks about in case the remuneration paid is considered to be excessive in accordance with law, how the excess remuneration has to be recovered or it should be refunded by the concerned director, and what are all the rules relating to that. In fact, this particular section now getting more and more importance because wherever there is a fraudulent case or wherever there is a restatement of accounts happens and the profit as per the restated accounts is lower than the profit as per the original audited accounts, then the computation under section 198 will also throw out only a lower remuneration payable. Suppose if the remuneration already paid is excessive, then there is a requirement to actually refund that particular item. We will discuss that a little later at length. And of course, section 200 gives power to the central government with the approval of appointment, fixing the remuneration in case of inadequacy of profits or absence of profits. You can get the prior approval of the central government, and based on which you can also make the fixation of the remuneration for the key managerial personnel. Of course, the Schedule 5 is also important for us to consider because it talks about the maximum remuneration payable in case if there is inadequacy of profits or absence of profit in respect of a listed company or a public company. So that's the way in which we look at that. And one thing which I wanted to reiterate that section 203 talks about which company should have the key managerial personnel. So where we are talking about public company having paid up capital of 10 crore or more, right? Whereas when it comes to remuneration and applicability of Schedule 5, all public companies are get covered, not necessarily based on the threshold limit of 10 crore. So let us look at what is the overall remuneration payable to the key managerial personnel. 11% of the net profit is the upper limit by a public company to the directors. That's the reason why I use the word public company without any threshold limit for the paid up capital. So 11% of the net profits. Up to the 11% of net profit, if any company makes a payment, absolutely there is no requirement for them to look for any particular approval. So terms of appointment can very clearly mention that and it can be adopted in the board of directors and automatically it goes up. And in case if the company is having the nomination and remuneration committee or NRC, the NRC makes the assessment, NRC recommends that remuneration to the board and board approves that particular situation. If no NRC is there or NRC is not applicable, then there is no question of NRC comes into the picture, directly the board will do that particular activity. When we use the word director, the law very clearly explains that the term director also includes the managing director, whole-time director, or manager who has been given the powers to govern the entire company. So accordingly, whole-time directors are also get covered, and the total remuneration payable to all of them put together cannot be more than 11% of the net profits. And again, in case, if you wanted to make a payment of more than 11% of the net profits, then the approval under the Companies Act 2013, which is little relaxed compared to 1956 Act, is that shareholders can approve that because they are the owners of the company. They can approve by means of a resolution in their meeting, and there is no need to go for central government's prior approval. Previously, we used to get the prior approval of the central government also. That is not required under the 2013 Act. Normally, the whole-time directors will not get any sitting fees. Accordingly, for calculation purposes, it is redundant, but still it uses the word sitting fees paid or payable to the directors are excluded in calculating that 11% of the net profits. Okay. What is the remuneration payable to the managing director and whole-time director? There could be some other directors who are not whole-time directors. What is the amount payable? In case if the company has only one managing director, 5% of the net profits. Suppose if the company has only one whole-time director, again that 5% will apply. 10% of the net profits will be payable if there are more than one managing director or whole-time director. That means we have to see the composition of the board of directors, and if there is one managing director and whole-time director, the maximum payable is 10% for the MD and whole-time director put together. Okay. And then remuneration to directors, not being manager or managing director or whole-time director, is capped at 1% of the net profit if there is whole-time director and MD. So MD is there, then 10% goes to MD and whole-time director and 1% goes to the other directors. If there is no MD, then 3% goes to the other directors. In excess of the limits of this, whatever 3% or 10% or 5% for a managing director or whole-time director, within the 11% can be paid with the approval of the shareholders and no central government approval is required. Okay. That is also an interesting point to see. Within the limit, you can restructure how you wanted to remunerate a particular managing director or whole-time director. Again, some questions which we have is whether these limits apply to a private company. You remember that we started with saying that the amount payable to a public company is within that limit, and Schedule 5 also we have talked about what is relating to public company in case there is an inadequacy profits or absence of profits. And accordingly, this limitation of 11% of profits or maybe 5% for MD or whole-time director, etc., will not apply for a private limited company. A private limited company can fix remuneration according to its own discretion by the board of directors, and of course the shareholders' approval is also not required in respect of a private limited company. At the same time, one word of caution: you may fix up huge remuneration to the directors of the company. In a private limited company, normally the directors will be the promoters or maybe the shareholders, and accordingly considered as a relative for the purposes of Section 40A 2B of the Income Tax Act. So 40A 2B gives a power for the assessing officer if he considers the remuneration is excessive than the market price, to disallow that and add it as taxable income. Okay? And of course, if he is disallowing that, to that extent, the person who is receiving it will not pay tax on that amount. Only what is allowed, he will be making payment on that particular amount as well. But the issue here is whether it is excessive payment or not excessive payment is what we have to look at as part of the Income Tax Act also when you are fixing up the remuneration for the private limited company. In my own cases also, when we have huge private limited companies who are having even turnovers of more than 1,000 crore and other aspects where they are specifically covered under certain provisions of the Companies Act, we are very particular that whatever remuneration has been fixed and whatever percentage based commission is fixed or profit based commission has been fixed, we ensure that it is comparable with the market situation because of the income tax angle is also comes into the picture. So that is for the private limited company. The Companies Act does not have any threshold limit for the upper limit of remuneration payable. The second question normally comes is, suppose if the private limited company is a subsidiary of a public company, whether this threshold limits or the maximum remuneration payable is applicable, the answer is yes. Even though Companies Act 2013 not specifically saying that a private limited company which is a subsidiary of the public company will be considered as deemed public company. The deemed public company concept is not there in Companies Act 2013, but still this particular provision says yes, private limited company which is a subsidiary of a public company still has to go with the threshold limit. It cannot go beyond that limit like a normal private limited company. Another interesting question people will always have, okay, I am a private limited company, but I am a subsidiary of a body corporate, so which is incorporated outside India because of the MNC setting up their subsidiaries in India. This question also comes in, whether there is a threshold limit which we have to look at equivalent to what we are looking for a subsidiary of a public company in Indian private limited company, whether we are giving the same parallel for a subsidiary of a body corporate. The answer is no, they are excluded. So they will be treated as a private limited company under this particular provision, and accordingly whatever you are doing for a private limited company will apply to them and not like a public company. Another interesting question comes. For example, this is normally comes in a case of say for example a hospital where the managing director or director is also one of the consultant or who conducts certain operations, etc. And the hospital pays him certain professional fee. Whether that professional fee should also be included in calculating the threshold limit of the maximum remuneration payable, the law categorically says what is payable as a director of the company has to be within this limit. What is payable in his professional capacity is outside the purview of this particular provision. But only requirement is who is professional under the Companies Act is defined, and he must have the requisite professional capability. For example, when I use the word hospital, you are paying professional charges to a doctor who is a general physician for conducting a heart surgery. Definitely it is not having the required professional qualification to get that professional fee. So you have to be little careful in what type of professional fee which you are paying, whether he has the required competence under the professional capability to get that as a separate item. If so, it is excluded from the requirement of the computation. Some more questions, whether the managing director or the whole-time director who is in receipt of any commission from a company can also receive remuneration from any holding company or subsidiary of such company. Normally happens. So I have seen cases where closely held companies are having, in one company he is a managing director, in another company he is getting a percentage of commission based on the profits. Whether it is possible, but only requirement under this particular section is you have to see wherever he receives from a subsidiary or from a holding company, both put together threshold limit should not exceed. Now the question comes, suppose if one company is a public company, another is a private limited company, whether I have to look at the eligibility put together or I can independently handle. Very recently we had this particular situation. One of the company is a listed entity and they also have a private limited company. Because of the chairman and managing director passed away in last year, there is a reorganization which has happened. So the wife of the chairman and managing director has become the chairman of the company. The son of the managing director, who was an executive director, has become MD of that company. And he also holds the chairman and managing director in another private limited company. The question immediately raised by the auditor of the other private limited company is that you should look at what is the remuneration paid in the other company, then you have to work out what is the total maximum remuneration payable under section 198, and it has to be restricted either in that company or in the private limited company. And we had a different view. So we did a research and finally we concluded that unless they are both parent company and subsidiary company, that type of relationship, law doesn't require you to aggregate this to check overall maximum remuneration. If it is two different companies, one is a public company and another is a private limited company, even though there is a common director, common managing director, absolutely individual company-wise limit has to be worked out. It was there in 1956 Act where the aggregate limit has been looked at, whereas in 2013 Act it is not there. Individual limit has to be checked and accordingly the private limited company can fix any level of remuneration because Schedule 5 is not applicable to them. Whereas in the case of the listed company, Schedule 5 is applicable, so the overall remuneration cannot go beyond that 11% of net profit unless approved by the shareholders of the company. So this is one peculiar situation we come across very recently. Whether the managing personnel can receive remuneration from two companies and how the limits are to be computed, as I have mentioned that if he is receiving from two different companies and there is no holding or subsidiary company relationship is there, Schedule 5 explicitly says individual eligibility limit or threshold limit has to be worked out, not combined limit. And accordingly, you have to work out like that. Another question which normally comes up is remuneration when we were talking about, suppose the director's indemnity policy has been taken by the company and premium has been paid by the company. In that particular situation, whether the premium paid covers the overall board, but any portion has to be attributed as a perquisite or part of the remuneration of a KMP as well. This is also another critical question which comes to our mind. Fortunately, the law was very clearly mentioning in the requirement of Schedule 5 itself that any premium paid on director's indemnity policy will not be part of the remuneration for the purposes of section 198. So accordingly, that will be over and above the remuneration which will be considered. The next issue or the point of debate comes is that if you look at the definition section, section 2 subsection 78, it defines remuneration to mean any money or its equivalent given or passed to the any person for services rendered by him and includes perquisites as defined under the Income Tax Act 1961. That means what are all the items to be included in managerial remuneration is the first question, for which the definition gives you a very clear guidance. Any amount paid, whether it's a monetary benefit or non-monetary benefit or perquisite, all those things are covered as part of the managerial remuneration in your computation. In respect of perquisite, of course, it says that you go with the Income Tax Act and determine in accordance with the Income Tax Act and add that as part of the remuneration for your calculation. The moment I talk about the perquisite under the Income Tax Act, the next question comes is that whether the tax-free remuneration paid to any officer or employee is prohibited by the Companies Act. Suppose if some foreign directors are coming in, the terms of employment will say net of tax is not there. They say that what I am going to get is my money. Any tax on that is your payout. It is not my remuneration. Is it possible to consider that what is paid to the director is part of my remuneration in the P&L charge, and the tax paid on such remuneration is my tax outflow? Can it be possible? Again, coming back to Schedule 5 and the explanation of managerial remuneration, prohibition is not there. You can pay tax-free remuneration as well. But only thing is that it should be grossed up to the remuneration payable, and then you have to find out whether it is within the limit or not. You can pay tax-free. But having said that, you should also look at the income tax provisions, where income tax provision says that tax-free non-monetary perquisites can be given. You cannot give remuneration tax-free. That is what the Income Tax Act says, where the company can bear the tax portion. But of course, it's not an allowable expenditure under the Income Tax Act. If you are paying any tax on the perquisite payable to a director and you are bearing that, that will be considered as a tax outflow, and it is not allowed under the Income Tax Act. Whereas here, there is no specific prohibition, but you have to look into the requirement of the Income Tax Act as well. So other than MD or whole-time director, when we are looking at, there is no requirement to go for central government approval in case if you wanted to make a monthly remuneration. You can make a monthly remuneration. Suppose if you wanted to pay profit-based commission, whether you have to go for a special resolution, unless the Articles of Association requires a special resolution is mandatory for paying profit-based remuneration to a director, then only you have to look at a special resolution. Otherwise, you need not have a special resolution. An ordinary resolution is enough to pay to other than MD and whole-time director. Now comes to whatever I am talking about, Schedule 5, Schedule 5, Schedule 5. Inadequacy of profits or absence of profits. What does it mean? A loss-making company wanted to retain the directors. So naturally, it has to pay equivalent to the market level. But if I fix 11% of the net profits as the maximum amount available, then there will not be any amount which can be paid. Accordingly, an exception has been drawn by prescribing through a schedule to the Companies Act, Schedule 5 to the Companies Act, which says that you can actually pay a remuneration in accordance with the effective capital employed by the company. They have given a slab-based remuneration, and that will be the overall remuneration payable in case if profits are lower or there is no profits, company is making losses. So what is that actually talks about? This limit, again, an important point is that Schedule 5 is the overall limit without getting any specific approval from the central government. If you wanted to make payment more than the limit prescribed in Schedule 5, then you can go to the central government, get the approval, and make payment over and above Schedule 5 threshold limits as well. It is based on the effective capital of the company. Effective capital is defined. It will include not only share capital, but also include borrowals as well. So effective capital has been defined, and that is based on the effective capital. 4 different slab has been prescribed based on the effective capital, which I will show it in the next slab. If you look at this, normally, as company wanted to make the payment in accordance with the market rates, the slab rates has been given significantly equivalent to the market rate. So that is the reason why I say that for each of the slabs, the level of remuneration is really good. Suppose negative effective capital, or it is less than 5 crore, 30 lakhs per annum is what you can actually pay. Suppose 5 crore and more than 100 crore, you can pay 42 lakhs. 100 crore but less than 250 crore, 60 lakhs. 250 crore and above, 60 lakhs plus 0.01% of effective capital more than 200 crore. So if you see this number, even a small company or small public company wanted to retain good talents in the initial years, it is possible for them to pay this type of remuneration and retain the talents. Suppose still you believe that this is not enough to retain the talents. Shareholders can pass a special resolution and all the above limits will be doubled. For example, 30 lakhs becomes 60 lakhs, 42 will become 84, 60 will become 120. So if the company believes that I wanted to empower the board by retaining good talents, then I can actually pay higher remuneration by passing special resolution by the shareholders. Central government approval is not required in that particular situation. Suppose if the period of appointment or period for which he is there with the company is less than a year, then the remuneration will be prorated. Naturally, no? 30 lakhs will be prorated by 50% in case he is there only for 6 months in the company. Okay, that is the basic understanding of that. Arising out of that, lot of practical questions or practical issues which are coming in. Suppose if I'm a newly incorporated company, you might have seen that startups and other companies who wanted to bring in very high talents into that board, but fixing them low remuneration even by passing a special resolution may not be possible, and they wanted to pay more than that. One option is go to the central government to get it. But for a newly incorporated company, interestingly, the Act says for the first 7 years of your operations, the company can fix any remuneration, no limits. Any remuneration the company can fix. And of course, any remuneration subject to your 48(2)(b) of the Income Tax Act also, you have to bear it in your mind. So any remuneration can be fixed for the first 7 years without any limit. And after 7 years, you will go with Schedule 5 or as per the 11% if you've started making profits. Similar to that, is there any special limits available for a sick company? For the sick company also, they felt that the board should be stronger and accordingly good people should be there in the board for which compensation should not be a detrimental to attract that type of people. So they felt that here we will give 5 years without any limit from the date on which the company has been considered as sick. Any level of remuneration can be paid. No limitation is there for that particular company. Another interesting question, because previously we were talking about Sick Industrial Companies Act, which has been repealed, and we got the Insolvency and Bankruptcy Code. And based on that, there could be possibility of certain companies who are referred to corporate insolvency resolution plans. They might have gone into that process. And they might have got a resolution plan. That means instead of liquidation, somebody is ready to take over the company and run the company, and that resolution plan has been approved by NCLT and the shareholders of the company as well. In that case, is there any specific exemption available from that limit of Schedule 5? Again, they are saying for 5 years from the date of approved resolution plan, you can pay any amount as remuneration to the directors without any limit. You need not look at Schedule 5, what is the maximum payable. So these are all 3 exceptions. Looking at the practical situation of companies may be required to have to pay higher remuneration than what is prescribed in Schedule 5. And accordingly, law has considered that practical situations as well. Sitting fee, and of course, Section 197 allows payment of sitting fees, but only to non-whole-time directors, right? You can be part of the committee meeting, you can be part of the board of directors. Committee meeting, when I'm saying board committees are there, audit committee, CSR committee, and you have many other committees also. In case if you're talking about an NBFC or a bank, you have a lot of committees. Even risk management committee is a special committee which has to be there. Default, fraud monitoring committee is another committee which is there. And willful defaulter, who is going to be decided as willful defaulter, for that also there is a committee which is required to be formed according to RBI guidelines. So for every subcommittee of the board, what is the remuneration payable for the non-whole-time directors as a sitting fees? Actually, you can pay any sitting fees, but there is a limitation which comes in the rule, which we will look at a little later. And government, central government has the power, additional power. It says, I can decide what is the sitting fees payable for different companies and what is the remuneration payable, sitting fees payable for different independent directors. They have the power, but of course that power is not being utilized to my mind, they have not used that power at all, because they are simply allowing that sitting fees decision to be with the board of directors and the company and not intervening into that. What is the maximum amount payable per sitting or per meeting? As per the rule, 1 lakh is permitted. Previously it was 10,000 rupees, so it has now gone to 1 lakh rupees. And the questions which is again coming, remuneration by way of fee, there is another requirement comes in, can also be paid for such other purpose whatsoever as may be decided by the board for a non-executive director or non-whole-time director. So for example, if I am using the word non-independent director. See, if it is an independent director, there will be a conflict of interest, even if you are getting any other activity, and it has to be disclosed, etc. A lot of questions comes in. My suggestion is, don't get into the conflict of interest. For independent directors, maintain your independency in letter and spirit. If it is a non-independent directors, but not whole-time director, what type of additional amount paid? You can get only sitting fees, and you can only get a profit-based commission. And what else you can have? Suppose if I am asked by the committee to do a specific activity, maybe in my professional capacity, we have seen that is excluded from the normal payment which has been paid. And in fact, in one situation, we have even evaluated when a retainer fee has been paid to a firm of lawyers and the managing partner of that law firm is considered as an independent director, whether he is really independent is also we have considered, and finally our conclusion was he is not independent director. He is a non-independent director is what we have concluded, and it was agreed finally by the managing partner of the law firm also. Initially he was little hesitant and he was little felt offended, but later on he agreed that based on the analysis which we have done, he felt that what you say is correct. I am not to be considered as independent director. And the moment he is not an independent director, then we have to reconstitute the committee by putting one more person to ensure that the requirement of how many independent directors should be there in each of the committees, etc. Now, in case if I am a director of the company who is not a whole-time director, any other amount can also be paid, is what the section says. What could be the possible scenario? For example, if there is a subcommittee which has been formed, he has been entrusted with a specific task, he spends his time on that, and that can also be paid or compensated. He participates in the strategic discussions over and above what his role in his board function. that can also be compensated. He has been asked to carry out certain investigations specifically. Now, it's part of companies in a regular scenario, it happens wherever there is an issue relating to a whistleblower complaint comes in, whether the whistleblower complaint has to be handled by the audit committee or whether the audit committee should also constitute a subcommittee to do the initial review, investigation and then present the report. Assuming that we are forming a separate committee and we are asking 2 directors to handle that particular situation, then for that extra effort which they have put also, they can be compensated. These are all facilitating how business can be conducted with right talents. That's the way in which it is practically comes in as part of that. Independent directors, sitting fees for the board, subcommittee, profit-based commission can also be taken, but not stock options. In fact, in one of the resolution, they wanted to say the profit-based commission will be given by means of stock option. So that can be given only to a whole-time director and not for an independent director. The moment the independent director is getting a stock option, the law assumes that the independency is having a conflict. And of course, certain companies are prescribing qualification shares for independent director. That doesn't, because the Articles of Association specifically requires that doesn't have any implication, but the payment of allotment of a stock option is not part of the remuneration of an independent director. As we have discussed earlier, we also have one specific scenario where excessive remuneration has been paid. For example, amount has been paid, approval of the central government has not been received, and central government has rejected the application. The managerial person has to refund the excess remuneration paid, or he has to hold it in trust for the company. Maybe it will get adjusted in his subsequent remuneration, whatever, but he cannot get that money as his remuneration. The company cannot also waive any such amount excessively paid. It cannot be waived unless specifically permitted by the central government. This is another interesting point. One public company, I still remember that, central government rejected, asked to refund it. In the subsequent shareholders meeting, they have decided to waive the amount which has to be refunded. But it is against the requirement of law, and you have to go to the central government to get the waiver. Otherwise, it is not permitted to be part of it. This is very, very interesting point. In fact, it came in certain newspapers as well. I don't want to mention the company. The moment I am talking about the background of the company, you will know that 2 of the independent directors have refunded the excess remuneration paid to them after the company has been considered having a fraudulent financial reporting. They restated the entire profits for the past several years, restated the financial statement as well, and accordingly whatever has been paid was considered as excessive remuneration. Sorry, here there are seats available. So excessive remuneration which has been paid has to be refunded. So the order was also, the moment it is restated, 2 of them, according to law, the company has actually asked for refund of the excess money paid. So 2 of them has repaid that money. But 2 directors have mentioned that there is no such requirement when I have been appointed. It was only mentioning that this is the remuneration which I am eligible to get, and accordingly I need not refund that money. They have gone to court, but the case is still pending, but they will not get any waiver on that particular situation, because section was categorically saying that if there is a restatement of the accounts, the excess remuneration has to be repaid based on the correct profit which has been determined subsequently. Okay, that is up to that is what we are talking about on the managerial remuneration and the related issue. CSR, I just wanted to spend quickly some few minutes and not exhaustively on CSR section 135 and related rules. I am not going into that because there is a separate session on that. What is required is, what is the amount of CSR you have paid or spent and what is unspent, but according to the computation, you are supposed to pay. That computation is asking you to compute in accordance with section 198. Section 198 is relating to computation of profits for managerial remuneration. Same computation is used for the purposes of CSR as well. That is the reason why they are interconnected. This computation are interconnected. Only difference is, for the managerial remuneration, I compute only the current year amount, whereas for CSR, previous 3 years computation will be done, and average net profits will be arrived at 2% of that what we will spend. Suppose if you are not spending the 2% or you have spent the 2%, there are specific disclosures are required in the statement of profit and loss. That is what you have to do. If it is unspent, there are conditions. If it is a continuing, it is not a continuous project or ongoing project, then you have to transfer the money to the central government within 6 months from the end of the reporting period. Suppose if it is relating to ongoing project, within 30 days from the end of the reporting period, you have to transfer to the special account from which you have to spend on the ongoing project. If it is other than ongoing projects, then you will not get that money back. It is actually went to the central government. Section 135 amendment is asking you to do that. Of course, my friend will discuss that at length. What I am trying to look at is how the computation will be and what are all the disclosure requirement. One, amount spent, amount unspent has to be disclosed as part of Schedule 3 requirement. And then if you have spent the amount through related parties, you might have formed a trust, or a trust was already there, one of the director is managing trustee of that. Through the trust or related parties you have spent that money, that disclosure should also be there. Of course, you can cross-refer that disclosure through your for your disclosure in related party transactions, maybe AS 18 or Ind AS 24 as the case may be. You can cross-refer that particular note saying that for the amount spent through related parties, refer note number so-and-so. That can also be done instead of repeating it again. Then what is the nature of amount spent? Also, they have given certain guidance. Within this category, you classify them and show what is the amount you have spent. And you have to spend, also mention what is the amount spent on ongoing project, other than ongoing project, you have to disclose that information. Suppose if section 135 is not applicable to a company, is there any disclosure required under the Companies Act? Specifically speaking, if a particular section is not applicable to me, I need not worry about that particular section. I can proceed. No specific disclosure is required. But practically, we have seen certain cases where notices has been received from the regional directors saying that you have not made any disclosure under section 135, you have not made payment under CSR, they have not even applied the requirement of 135, but notices has been sent. Accordingly, now I suggest for my office and for my friends, you please say the provisions of section 135 is not applicable to the company. One line will take care of your practical issues. So that I started using it after we started getting certain notices and trying to reply for 3 times, 4 times to get the issues closed. If no ongoing projects are undertaken by the company, you have to spend that money within the year, or otherwise it has to be transferred to the central government. If the ongoing projects are implemented through the related party should have been an approved person under CSR, and then only you can do that. Just transferring a money to a trust is not a CSR activity. That is what it says. Mere donation to a foundation run by a charitable organization, whether it qualifies as a CSR spending. We are advising a company now where they have formed a trust, foundation. This company transfers the money to the foundation. More than 5 years, 6 years. They started transferring whatever 2% is required, they transfer to that particular foundation. Only one question has been asked, what the foundation is doing. Foundation is keeping everything in fixed deposit, earning interest. That means there is no CSR activity. So it is only a mere donation you have paid. If you say that I am doing this activity of CSR through a implementation agency, you have to monitor the provisions. So accordingly, there is a requirement to look at that specifically. I think Magesh will also agree that we had a detailed discussion on this similar topic in another forum on this. Whether a company can form foundation or trust and contribute money from them for carrying out CSR activity can be done. A lot of companies are doing it, but only requirement is that you cannot just make a donation. You have to necessarily look at whether they are really implementing a CSR activity or not. Jointly also, companies can carry out the CSR activity. Suppose if there is a statutory requirement, you have to spend certain money on certain activities. For example, if you are doing a mining activity and there is a statutory requirement that the environment should be there, a reforestation activity has to be done according to the requirement, then that will not be considered as a CSR spent. That is specifically excluded from the CSR. Unspent money carried forward from one year to another year can be spent for any other purpose. So unspent money only for ongoing projects could be possible to carry forward, otherwise it has to be deposited accordingly. So what is the project for which you have earmarked, you have to spend that money, otherwise you have to transfer to the central government. Excess money spent in 1 year, whether it can be carried forward, there is an accounting guidance which has been given by the institute where they said that because now once Section 135 is a statutory obligation, automatically there is a liability arises the moment Section 135 is applicable to you. So what is the total amount you have to spend? If you have not spent, liability has to be created. If you have spent more than what is required, then there is an asset available because carry forward that amount and adjust against the next year spent is permitted under Section 135. So accordingly, a liability or asset as the case may be should also be accounted for relating to CSR. And this is always a debate in CSR committees and board, in audit committee, auditors question. Everywhere this becomes one of the regular discussion point. What is the item on which you have spent this money? Whether it is there in your Schedule 7. Schedule 7 is relating to the activities to be covered for CSR activity. There is a guidance available. If that particular item is explicitly not there, can I conclude that this is not a CSR spent? Subsequently, lot of clarification has been given. What is given in Schedule 7 is only an illustrative list and not an exhaustive list. So you have to only consider whether you are really doing a CSR activity or not, and whether it can be considered under any of the overall head. So it is only an illustrative list and not exhaustive list is what it is given. 2 to 3 minutes I will spend, and I will share this Excel sheet also with the SIRC along with the PPT, which is showing you how the computation works out. Section 198. So I started, this is for managerial remuneration. So the remuneration paid to the managing director is also, or whole-time director, is also been debited and profit has been arrived at. So to arrive at my overall limit of 11%, after including that or excluding that remuneration, I have to look at, actually you have to see profit before payment of remuneration and then 11% has to be applied. Simple concept. That is the reason why profit or loss as per books before tax, and then I have added the managerial remuneration debited to the profit and loss account. This is the overall profit or tax. Specific items which are to be included or excluded, they have considered as to be added. Even though if you see, a lot of items I am just keeping it as nil for a simple reason. The profit I start is profit before tax. So all the income has been taken into consideration. all the expenses has been taken into consideration. Only item which I have not considered is relating to my managerial remuneration. And certain items which are not actually the actual amount to be excluded. Those items I have considered. This, for example, I have received a capital subsidy, and that amount is given by the government as a grant. That should also be added back to arrive at your profit eligible for taxation, remuneration. Premium on shares, if you have included, it should be reduced. Profit on sale of forfeited shares to be removed. Capital nature, including profit on sale of undertaking or any other undertaking. Here what people are thinking about is, suppose if I have sold an undertaking, any profit I have made on that should be taken straight away as an adjustment. But what it actually talks about is a capital profits. That means over and above your cost, that is a capital gains. If you have made anything, that process has to be added or deducted. If it is a loss, it has to be deducted. That is the case which you have to consider, but not the entire profit. And similarly, when I have sold a property or any property, plant and equipment, capital gains or capital losses, that amount alone has been adjusted, not profit on sale. Even though it talks about profit from sale of any immovable property, and whether wholly or solely or buying from that particular item has to be considered as part of that. Carrying amount, this is coming because of Ind AS application. Fair valuation comes in. It is a notional adjustment which we are doing, so that cannot be part of the profit payable as a remuneration to the directors. So that should also be reduced, which we have done. And similarly, any other bonus, etc., it is already adjusted, so I am not looking at that. In case abnormal profits, any tax has been levied. So far, government is kind enough not to levy any specific tax on that. But the Act gives some indication for them that they can levy one more tax also. And any tax on profit on special reasons is not there. Interest on debentures issued by the company should be added back. Interest on mortgage, interest on unsecured loans or advances. It is actually adjusted in arriving at my profits, and accordingly, there is no further adjustment required. Repairs and maintenance already adjusted to arrive at my profit, so I am not adjusting anything. And similarly, if you look at all these items, you have already considered those items as part of it. When you look at these items, you will see what we are trying to arrive at. In this case, I was having one managing director in that particular company. So I have arrived at what is the 5% of the amount which is payable, what is actually provided by the company for the year, whether that is within the limit. So is there any excess remuneration payable? No. Whether compliance with that, we have considered yes. Same thing which I have done, not for the current year, previous 3 years, and then arrived at what is my average profits for the last 2 years, on which 2%, and then any shortfall or excess of the previous year is adjusted, and what is the net amount spent during the period, whether there is any excess amount paid or is there any shortage. If there is a shortage, when we have completed the audit, what is their plan? Is it an ongoing project or not an ongoing project? If it is an ongoing project, whether they are transferred within the timeline, or if it is not relating to ongoing project, what is their plan to transfer that money within that? That should also be part of the notes which is required to be given as part of the notes and accounts in profit and loss account. So that is the interconnect between these two topics, CSR and managerial remuneration. Otherwise, you have a full session on this. Any specific questions, I will be happy to take those questions, maybe one or two. We started 45 minutes late, but I have to give the session to the next speaker who is already available. So I am completing it a little faster. Yeah, please, sir. Naturally, because it is a charge on the profits. Managerial remuneration is a charge on the profit. That is the reason why I put one green column in the computation, but I have not added any amount specifically because it is charged in the P&L already. So I considered that as an expenditure charged to the balance only is the eligible profits on which 2% has to be spent. And another question normally comes is, 1 year I have loss, another year I have profit. Third year I have profits. What should be? Fortunately, it is only talking about average profits, means loss should also be offset. Previously, people think that only profit has to be considered. Now, loss can also be offset. I started with profit before tax, so that means I have not considered anything relating to OCI. So automatically OCI is nothing but carryover in the balance sheet. So it is not an eligible profit, and most of the scenarios it is a notional profit. That's the reason why I started from profit before tax. You can.
But in ROC record, it will be only non-executive. So
You can pay remuneration to any director, even non-executive director also you can pay for a private limited company.
can be paid.
There is no limitation.
But under GST, they say, it will be treated as a, if it is not paid as a
Can you
non-executive
hold your mic?
non-executive director is not treated as an employee of the company, so it attracts GST also.
So that is normally what happens is Income Tax Act will have all these interpretations. Companies Act, there is no limitation. So that is the reason why, even though I am talking on Companies Act, I cautioned about income tax provision as well. Because I have scenarios where husband and wife are directors and remuneration has been equally paid to both of them because they are in the higher bracket. Well, wife was in the lower bracket of taxation. But the assessing officer has seen what is the role of the wife in the company's operation. And they have tried to show that she is signing the checks, etc. In the check signed, you can see that if one check has to be signed, she has to take at least 10 minutes. So that is her level of experience or her education. So then he has concluded that she is not actually contributing anything as a director, and accordingly it is excessive payment. So Income Tax Act, you should always keep it in mind for a private limited company.
In case of excess remuneration paid, because we will be calculating after completion of the financial year, that excess portion will be treated as a loan to directors under Section 185?
Normally what happens is, when the assessment comes, there is a problem. But even though I was mentioning that what was not allowed is not to be taxed in the other person's hands. But the problem is,
From Companies Act angle, the excess amount, you will calculate this only after financial year. So
Correct.
As on 31st March, it is excess paid. So difference
Correct.
will be treated as a loan to directors?
Correct. So what normally happens in such cases, I have seen balance sheets of certain companies where they used to say, this is the total remuneration, this is an excess remuneration paid during the year, subject to approval of the shareholders by a special resolution. So they will put that as a note in the notes and accounts. If it is not approved by the shareholders, he will refund it. Normally shareholders will approve based on the past trend. We know that.
Sir, based on the recent changes in the Income Tax Act, there is a lot of advantage in terms of taxation of getting professional charges instead of remuneration. If it's an eligible category, like a person with a talent and does that. So how will the professional charges, whether that can be treated like remuneration for the purpose of Companies Act, where even if there's an advantage to the director and he falls in the category, that okay, he can.
It is not considered as remuneration, as we have discussed already. It is not within that limit. You can debit to professional charges itself. I have seen corporate hospitals showing the remuneration paid separately to the directors, and when they are doing a professional service as doctors, that has been charged to a head called professional charges or consultant fees. So that will subject to TDS in a different perspective, and this will be part of the remuneration.
So even if that demarcation is available, then
yes, it's available, provided he really holds the professional capability.
Understand, right.
Then it is possible.
Perfect, thank you, sir.
Yeah. Can you use mic, please, sir, because it's for benefit
No,
of...
this CFO and CS salary, that is also part of that 11%?
No, sir.
No.
That is only for directors, managing director, whole-time director. CFO salary is not part of that particular 11%. There are two sections. One is, who is KMP, separate section 203. What is the maximum remuneration payable is section 198. So section 198 is not covering company secretary and CFO. In fact, they are not considered as related party under the accounting standard, but they are considered as related party under the Companies Act. Okay, maybe any other questions which we will have, we will discuss offline. With that, thank you very much for your patient hearing and making it interactive. This presentation is actually available with the SIRC. I think they upload it as part of their website, which you can download. The Excel also, I will share it with them, so for uploading it. Thank you so much.
On behalf of SIRC of ICA and all the delegates present here, I extend our sincere and heartfelt gratitude to C.H. Chinnsamy Ganesan sir for an insightful, thought-provoking and highly enriching session. So we are deeply thankful for the time, effort and expertise you have shared with us today. So we will have a short tea break and we will reconvene in 10 minutes for the next session.
Section 10A may be contravened after signing of an audit report, but as on the date of signing of audit report, there is no contravention. How to report? At least we all are at consensus, there is no contravention, right? Because there is no contravention, there is no qualification. Because there is no contravention, there is no adverse remark also. Then only one thing is left. Emphasis. You know, we chartered accountants have taken emphasis of matter paragraph as a kind of residuary paragraph. If no para is fitting at any other place, fit it into emphasis. Now what is emphasis? Please understand, then you will be able to correlate. Emphasis of matter report is given when few conditions are fulfilled. Condition number 1. Condition number 1 is there is no contravention of the law and hence no qualification is required. Fulfilled? Yes. Condition number 2. The matter must be disclosed in notes to accounts. Is it disclosed? Answer is yes. Because journal entry is there, balance sheet is there, so note will be there. And number 3, more important. The matter must be so significant, that it is fundamental, to the understanding of users. It is very fundamental matter, share capital. So what we will do? We will do emphasis. How emphasis will be happening? We will prepare a report. Heading will be emphasis of matter. Below it, what would write? We draw the attention of users to note number X of notes to accounts regarding this subscription money, which was not received by the company on the date of signing of audit report, and 180 days are yet to elapse. Our opinion is not modified for the same matter. Over. Challenging situation now. If I assume the money is still not received or money is partly received, out of 5 lakh, let us say nothing was received or 2 lakhs were received as the case may be. And on the date of signing of audit report, what stance we will take? Because 180 days have expired. Contravention has taken place? Yes. Qualification will happen? Yes. And SA 705 says, whenever you qualify, give the financial impact also. What is the financial impact? Either entire rupees 5 lakhs or balancing figure. If in my example I said 2 lakhs were received, 3 were not received, the financial impact is 3 lakhs. Now, ask yourself a question. Besides qualification, anything else is required? One is qualification, agreed. One more reporting is missing. I can give the hint, going concern. The House may recall, we have section number 248, subsection 1, clause D of the Companies Act. Section 248 deals with striking off. Now section 248, subsection 1, clause D of the Companies Act says that if a company has contravened the provisions of section 10 capital A, that means this section, ROC has the powers to issue show cause notice and strike off the company. That means as on 27th of June, immediately after 180th day, the power of ROC is triggered. At any point of time, he may issue show cause notice. That means on the date of signing of audit report, uncertainty is there. Whether this company will survive or not, will be struck off or not. And that's the reason we have SA number 570. SA 570 deals with going concern. What do we have to do? We will prepare a paragraph on the face of audit report, material uncertainty about going concern, and then we will mention this fact. Section 10 is contravened and hence striking off may happen. May happen. Why may happen? Because you are not adjudicating authority. ROC is the authority. In most of the audit reports, either all these elements were not there or a few of the elements were not there. At least I can say this thing, going concern reporting and never found. And this mistake happened in most of the cases for startups. So chartered accountants incorporated the company, which is allowed also. Chartered accountants incorporated the company, then they became auditor of the same company, but this money was not received or was belatedly received, but the report was still true and fair. And imagine a situation, if this happens, even if the amount is immaterial, the event itself is material. Event is entire company under stake. And this is a case of gross negligence. And none of us can claim that we were not aware. At most what can happen, we may not be able to recall a section number. At most this can happen. But nobody will accept this theory that a chartered accountant is not able to recollect that this going concern is getting impaired. And that's why the clip which I skipped, let me go back. This was the clip. In one case, there was unpaid amount towards shares subscribed by the subscribers of the MOA. The company has gave a descriptive note. What company did? They gave the notes to accounts only. But no balance sheet reflection was there. And that's why I covered section number 2, clause 64. So it's simple FRRB, what it stated, FRRB stated that in balance sheet, you have to do this thing, subscription money receivable, and second is paid up capital. One thing which is not the domain of FRRB, that's why it touched separately audit report. Going concern may be required a reporting in a separate case. I believe this point is clear. Okay. This I will skip because I have covered this thing. Sorry, this I will touch. In one case, what happened, you may recall that Schedule 3 says those shareholders who have more than 5%, they must be disclosed. This is regarding that. In one case, shares in the company held by each shareholder holding more than 5% shares were given by specifying the number of shares held. Now, what is the mistake? The company, however, gave such shareholding for total number of shares in aggregate, whereas the notes also stated that company has issued equity shares as well as preference shares. I believe this yellow paragraph must have given you answer also. So when we have to give the 5% range, we have to give separate class of equity as well as preference. Both need to be, but in normal case, most of the private companies will not be having preference, but if it is having, then what you have to do, you have to bifurcate. And that's the reporting also by FRRB. Guidance note requires companies should disclose the shareholding for each class of shares, both within equity and preference, and this information should be given for comparative period as well. Comparison though we always give, only problem is that generally what we do, we club equity and preference. Rather what is required is equity separate, preference separate. See this one. In one case, the loan payable by the company was converted into equity. Loan payable was converted into equity. By passing special resolution, you can do so. Under an arrangement between the company and the lender. Now what company did? Company disclosed the same as shares allotted as fully paid up pursuant to contracts without payment being received in cash. So what happened? The loan was converted into equity. And the company stated that this is a non-cash allotment. It is correct. Simply think as a class 12 boy. When this loan was received, what was the journal entry? Bank debit to loan payable. Now, when this conversion happened, what happened? Loan payable debit to equity. That means if I net it off, the entry is bank debit to equity. So cash is received. That means it is wrong to say it is a non-cash allotment. And that is the same thing which Institute also said. Guidance note says such an allotment is considered as shares allotted for payments being received in cash. That means this cannot be called as non-cash allotment. How many of you? Yes, sir. Yes.
So 42, private placement. How to overcome this?
So that I will discuss once I will come down the floor. The recording is going on. My documentation is very severe. But I will tell the answer once this speech will be concluded. I believe this point is clear. Okay. This I covered through my case study. This also I covered through case study. Yes, this is one. In one case, the company was having long-term borrowings. The company nowhere separately disclosed the current maturities of long-term borrowings. Has to be disclosed, that is correct. But where? Current maturities of long-term borrowings. I can give the hint. For this, some amendments have taken place. Okay, let me give you one more hint. Let us play KBC, Kaun Banega Crorepati. Whether this current maturities of long-term borrowings will be reflected as current liability or short-term borrowings or long-term borrowings and separate caption, current portion of long-term borrowings, short-term borrowings, and that's the thing. So what happened till 31st March 2021? Current maturities of all long-term borrowings were required to be disclosed under other current liability. This was the old scenario. But after this amendment, what happened from 1st for 21, the current maturities of all long-term borrowings will be disclosed under short-term borrowings and not under other current liabilities. How many of you scored rank in CF handle? Okay, so those who are rank holders, let me take the revenge because I never scored the rank. Question is for the people. What we are doing here, we are classifying that current portion and we are reflecting it is in short-term borrowings. Short-term borrowings. Now, when we will prepare cash flow statement, so we make some adjustments, cash from operating activities, then working capital changes, current assets, current liability changes, whether in that cash from operations, this will be adjusted. Answer is no. It is merely a presentation change. It is merely a presentation change, but not the change in nature. That's why they scored rank. One more question for the house. Just see and don't be in hurry to answer this one. So company was having secured long-term borrowings. You may recall the law says in Schedule 3 that whatever borrowings you have, you need to bifurcate it into secured portion and unsecured portion. So this is the discussion which will take around 5 to 6 minutes to discuss. Now what company did? The company disclosed that all long-term borrowings are secured against the tangible assets owned by the company and personal security promoters, shareholders and third parties. You can read this paragraph in two parts. First part is borrowings are secured against tangible assets owned by the company, and second part is borrowings are secured against personal security promoters, shareholders and third parties. Let us take sub-question number one. Sub-question number one. Company has certain term loans, which are long-term, and company has given property, plant and equipment as security. So let us say 5 term loans are there. Can we write in the balance sheet, all the term loans are secured against this property, plant and equipment? Answer is no. We have to specify separate security for each corresponding loan. Blanket disclosure is not allowed. Now be careful. I have 2 more questions. One question from this side, one question from my own side. The other question is, company borrowed, director guaranteed. Company borrowed, director guaranteed. Director said, if company will default, personal guarantee will come to rescue the default. Whether this is secured loan? Answer is a very big no. Very big no. For the purpose of Schedule 3, secured loans are only those loans which are secured against the property of the company. This guarantee is not the property. So what you will do, you will write it in unsecured loan, but you will describe the nature of this loan. The nature is unsecured loan against the collateral or the guarantee given by director. And this person being the director, in notes to accounts, we have to disclose AS 18 disclosures also, RPT. Are you getting my point? Third question. Let us take a situation. You purchased a vehicle or a Mercedes car or a France car. You purchased a car. In India, tendencies when we purchase the car, we purchase it on EMI basis. Now you purchase the car on EMI basis. The car's RC was showing hypothecated with RTO. Whether this EMI based purchase, I am assuming the car is in the name of company. So company purchases a car for the use by director. Car is in the name of the company and it is financed by HDFC Bank. Whether this purchase of vehicle on EMI basis requires charge registration with ROC. Answer is a very big yes. National Company Law Tribunal and CLAT. National Company Law Tribunal in the case of Volkswagen. In India, we pronounce it as a Volkswagen. And CLAT Delhi in case of Volkswagen Finance Limited held that this charge also requires registration with ROC. Imagine a situation. How many companies will be there who have not registered this charge? And post amendment, which was made in March 2021, Schedule 3 also requires whether charge is registered or not. If not, then disclose the effect. So you have to be very careful. Second question for the house. And for this question, I give the credit to Madras, old Madras. You will get to know why. Company borrowed against security of FD, fixed deposit. Question is, if FD is given as a collateral and then borrowings are made, whether this requires charge registration. Half of my dear chartered accountants, what they are doing, they are searching on Google. And with the whole bluntness and frankness, I must tell you, when you search on Google, you may try this now also. Whether charge registration is required on this kind of FD, Google will give the answer from one of the Google group. That group I will not name, but you will search, you will get. And that Google group says that charge registration is not required. And then they will quote a judgment of Madras High Court also. Sri Meenakshi Mills. Now, what happens? Chartered accountants simply see and they become happy. They never analyze. This judgment pertains to the Old Companies Act. In Old Companies Act, we were having section number 125 4E, which today is section number 77. Now, Old Companies Act was exempting this charge to be registered. But in the New Companies Act, there is no such exemption. So, if in your working papers, you are writing that no qualification is warranted for this non-compliance or compliance by the company, because Sri Meenakshi Mills case, it is totally unwarranted. Because as on date, we have two sections. Section number 2, clause 16 of Companies Act, which defines charge. And second is section number 77, which says charge registration. Both the sections put together, what they say, that this borrowing with FD collateral being given to the bank or any lender for that matter requires charge registration. And if it is not being done so, obviously disclosure in Schedule 3 is required. And this is only for creation. Schedule 3 also satisfaction. So charge which was satisfied but it was not filed to ROC, that also requires reporting in Schedule 3. So these two matters are very critical matters. I would request each one of the listener that car purchase or vehicle purchase on EMI basis, charge registration required. FD being given as a collateral under the New Companies Act, charge registration is required. Let us proceed. So ma'am, if you refer section 77, what it says, charge can be registered either by the borrower or by the lender. Now question arises, if the banks are not doing, can a company take up plea? I will also not do. It's my revenge. Reason for delay could be the admin reasons for non-cooperation by the bank. That could be disclosed, but for disclosing this thing, it's easy for me to say from this place. But ground reality is very different. So what you can do ultimately, you can simply qualify the report. Because you will say, for this qualification, there is no impact. But there is a contravention. That is the problem. And you know, we have one more standard, SA 505, external confirmation. Always write a letter from the part of the auditor. But we came to know that this is the transaction which happened with your bank. And for this charge was not registered. Kindly confirm. Bank will not reply. But ultimately you will be safe. Because as auditor, we cannot chase. We can at most dilute the risk or eliminate the risk. Elimination can never happen. Yes, sir. Yes. Yes. Right. Sir, I never use the words hire purchase. But yes, even if now I use hire purchase, still it is required because section number 2, clause 16, it has used the word charge also includes any interest therein. So it is an interest, the benefit of which is accruing to me directly or indirectly. Old companies, this was not the problem. New companies, what they did, see what happened, we need to understand the history or logic behind it. When this new companies that came, insolvency bankruptcy code was in making. So to avoid the future inconsistencies, what they did, they tried their level best in 2013 itself to overcome all such infirmities that may happen in both the laws, IBC and Companies Act. That's the reason the definition of charge in Companies Act, if you will see in IBC, both are almost similar. That's the reason. But those days, what was happening in the old Companies Act, even SARFAESI was not there. That would be there, sir. Sir, try to understand. I borrow your point and I endorse it also. But try to understand, we are into two different literatures. The objective of Companies Act is governance and discipline. Whether it is achieving or not, that is a different story altogether. But the objective of income tax is revenue collection. And that's the reason, if you see on a very minute side, depreciation in Income Tax Act is higher in the initial years. Company law, it is almost consistent or lower. Objective is different, sir. See this question. In one case, the company was having some leasehold improvements, and the company disclosed leasehold improvements by clubbing the same under assets held under lease. What is leasehold improvement? Let us assume you took an office on lease. You took an office on lease. Now this is the office on lease. Now what you did? You did some painting, curtaining, and some ceiling. Who did this? Not the landlord, but the you. And when you did this thing, it is a leasehold improvement. It is a separate component of asset. Separate component of asset. So these leasehold improvements cannot be classified as assets under lease. Rather, the name would be leasehold improvement, and it will separately come below the heading property, plant, and equipment. And that is what the concept of component accounting is. And the answer for this question is guidance note says, guidance note means schedule 3 guidance note, leasehold improvement should be shown as separate asset class. One more question. How many of you are reflecting property, plant, and equipment like this, land and building? When you will see your block of asset, balance sheet block of asset is there, no? So balance sheet, property, plant, equipment, note number 3. Note number 3, when I saw what is the note saying, land and building, furniture and fixtures, computers, vehicles. I am not bothered about other assets. I am bothered about land and buildings. This land and building, is it correct? What is happening? Because of this land and building scenario, land is also getting depreciated. And if my memory serves me right, we have para number 58 of AS 10 revised. But it says land and buildings always need to be segregated. And how to do segregation, that AS is not telling. So for that segregation, there could be some rational basis. For example, you may take quotations from, let us say, Magic Bricks or maybe some architect, and depending upon that fair value, the whole WDB can be apportioned. And you will depreciate only building, not the land. And you will see most of the balance sheet still the practice is land and building. So what the leverage they say, we acquired both together. So if you acquired both together and if you say it cannot be divided for the limited purpose of substance over form, the fair value attribution needs to be made. And this is what we need to always capture, that land and building, do not show them together in your block of asset, because several times ICI repeatedly said this is a wrong thing. And for this purpose, now what is happening? With effect from 1st for 2016, we have Accounting Standard 10 revised. After the revision of AS 10, Ministry of Corporate Affairs very specifically written over there in para 58 that both need to be separated. Both are separate components. So I will take last question before I leave because my flight is at 4:30. So let me show you one tough question. This Caro I already covered. Share application money I have to touch upon. See this question. In next 5 minutes we will resolve this one, then we will wrap up. This question, I believe, is one of the most contravened scenario of the real world. Just see. Company is RST Private Limited, and the balance sheet extract says that the company received share application money, rupees 1 crore, on 15 January 2024 through banking channels, and the money was outstanding on 31st March 2024. The money remained outstanding even as on 31st March 2025. Now, contravention is okay. As an auditor, what are the number of contraventions? You will see and check over here. So I am saying contraventions. Company is at FEMA, but there is no FEMA involved, sir. Yes. Okay, let us forget about this thing. Let me straightforward come to the point. Can you see any director's disqualification here? So disqualification of directors, is it happening? I can give you the second hint. We do have section number 143, subsection 3, clause G of the Companies Act. The section says auditors have to report whether any of the director is disqualified under section 164, subsection 2 of the Companies Act. After this, I have no hint, only the answer. So to make the answer very quick, contravention number 1. We do have deposit rules. Rule 2, sub-rule 1, clause C, item 7. In short, I will say deposit rules. Deposit rule says, if a company, public-private doesn't matter, if a company has received share application money, the money shall be allotted within next 60 days. If it is not so allotted, refund it within next 15 days. And if it is not so refunded, it will be deemed as deposit. Now, here what is happening? This money became deemed deposit. As of 31st March 2025, it is a deemed deposit. Contravention of deposit rules. It requires reporting in CARO, if applicable. CARO, para 3, sub para 5. Contravention number 1. Contravention number 2. We do have section number 42, subsection 6 of the Companies Act. Section 42, subsection 6 of the Companies Act says, when this money will be refunded, you have to pay interest also. And the interest is 12% per annum. Now, if this interest is not provided for in the books of accounts, 2 contraventions are happening. Section 42, subsection 6, as well as accounting standard 29 or Ind AS 37 dealing with provisions, contingent liabilities and contingent assets. Interest wala point. Number 3rd, section 164, subsection 2, clause B. Section 164, subsection 2, clause B says, if a company, other than government company, if a company has defaulted in annual filing for 3 continuous years, or the company has defaulted in repayment of debentures or interest thereon, deposits or interest thereon, for a period of more than equal to 1 year, for a period of more than equal to 1 year from the due date, then the directors of the company shall be disqualified for next 5 years. Disqualification is happening. And but we are reporting in the audit report on the basis of representations received by us. We report that none of the directors are disqualified for the year ending on 31st March 2025. This way, what will happen? Apparently, gross negligence is also there because you are saying on the basis of written representations. That means you never vouched your own. You merely relied upon the representations. I believe you must have understood the gravity of this problem. Share application money entails not only deposits rules contravention, interest, Ind AS contravention as well. Director disqualification may also be entailed. And this is only, tip of the iceberg. Share application money. There can be many other deposits also. For example, customer advances for more than 365 days. What the deposit rules are saying, if you have customer advances for more than 365 days, they need to be refunded within 15 days. And if it is not so refunded or appropriated, then what will happen? Again, the same thing. Disqualification of directors. Yes, sir. Sir, there are two things. Disqualification and automatic vacation. So directors will be disqualified and they will automatically vacate office of all the companies where they are directors except this defaulting company for next 6 months. So what I discussed is section 164. What you are asking is section number 167. But ultimately, directors are under soup. And this is what audit is. See, ladies and gentlemen, gone are the days when audit merely used to be ticking game, vouching line by line, tallying of balance sheet, finding the 1 paisa difference in trial balance. I remember when I was doing my articles, then those days manual bookkeeping was happening. Everything will go upright, but on the last day it all happens. Nature call. Last day naturally it happens. Trial balance will throw some difference. Then your sir will beat you. Nowadays we cannot beat our articles, otherwise they will beat you on the road. But yes, this is happening. Now the concept of audit is risk-based audit. This is the risk. The government understands shareholders are not worried about 1 paisa, 2 paisa. Shareholders are worried about compliance risk, reputational risk, continuity risk. And what we are doing still? Vouching verification. We are still, chasing audit trail. Half of the population, maybe I should say total population. Last year, this population, North India population, West India population, East India population, Central India population, what they did? They made use of a WhatsApp university. On WhatsApp, one big file was circulating, sample audit trail reporting. And then whatever reporting was fitting to our case, we simply reported. Please don't do this thing this time. In audit report this time, for audit trail, what you have to write, audit trail was preserved. Last year what we reported, preservation reporting is not applicable. But this time what we have to report, it is applicable and it is preserved. Why this was the concept? Companies Act says you have to preserve books of accounts and other records. So last 8 years, audit trail was applicable for the first time last year. So last 8 years are not available. This time what is happening? Out of last 8 years, 1 year is already there. So when you copy paste your audit report this time, simply don't change the year from 24 to 25. Also change this audit trail paragraph that audit trail is preserved properly, provided it is preserved properly. So otherwise, things will be in a troublesome area. And last but not the least, before I say tata bye-bye to you, whenever you do audit, especially this time, Chinnsamy sir is not there, and in his absence, I must bring this to notice of all. This CSR profit computation, that Excel sheet which sir was showing, it's not merely for computing 2% average spending. It is also applicable for assessing applicability. You must have heard of Kamal Garg in Delhi, the place called Kamal Garg. So there are several traders who are private limited companies, but they are traders. Normally, what is happening, CSR becomes applicable when net worth is more than equal to 500 crores or turnover is more than equal to 1000 crores, but net profit is more than equal to 5 crores. So these, trader companies, generally they don't have so much of net worth to turnover, but they have profit near to 5 crores or 6 crores. Now, we do have explanation below section 135. Explanation below section 135 says, see the initial words, for the purpose of this section. The word is this, for the purpose of this section, net profit shall be computed in accordance with section 198. So when you evaluate CSR applicability for a given company client and you compute net profit of the past year, so there could be a possibility that net profit as per P&L account of last year, it will say profit 4.80 crores. And you may be a concluding party to say CSR is not applicable. But when you will do some section 198 adjustments, it may touch 5 crores. CSR becomes applicable. So when you advise your clients, be very careful. And what is the carefulness required? Even for the purpose of CSR applicability, the net profit shall be computed as per section number 198. This is the point I need to add. Now, should you have any queries, you are most welcome to ask me. And whatever books I have written, I must give credit to Chennai. I started my career from Chennai, maybe in year 2000. And my teacher used to be there, who is no more on this planet. That teacher told me, Kamal, why don't you write one book? So he advised me to write one book. So I give this credit to Chennai that I started book writing from this place, although those days through pen and paper. Today, by God's grace, I am the author of 64 books. And this credit goes to Chennai. And I must say one thing, what I learned from writing the books. Each of the person sitting over here, at least write something. Maybe a book, maybe a write-up. What happens when you write? The assimilation happens. The perception changes. And I have seen this difference in myself. And this difference you can also observe in yourself once you start writing. When you will write now, you will be very cautious. You may not be cautious when you draft audit report because we're used to it. We did the same thing in articleship. We're doing now also. And Indians are not worried about penalties and fines. I must say this thing. So, for audit report, it becomes chalta hai attitude. But when you will write some article, you will borrow a kind of a moral responsibility that if a reader will read, what he or she will think. That moral tension will make us study a lot. And why I'm saying this thing? Because this audit, income tax, maybe next 10 years or 5 years. What next? For example, only 2 minutes. If I say today, Sachin Tendulkar, what comes to the mind? Cricket? If I say Rajnikant, what comes to the mind? Cinema? If I say Virat Kohli, again cricket. If I say Sanjeev Kapoor, chef. If I say, for example, Ashwin, chartered accountant, what will come to our mind? One of the participant in this hall. But when I say Girish Ahuja ji, when I say T.N. Manoharan ji, what comes to the mind? Some personality. Now what personality? You will say direct test guru. You will say awardee, like this. So how many of us carry this brand in industry? So if I take the name of Ashwin, Aniket, industry must recall, Aniket, Ashwin, this is direct test person, this is GST person. And for this brand building, this platform is not required. My father always taught me, and even today he teaches me like that. Your biggest power being a chartered accountant is not your signatures, is your vidya. That is your knowledge. Spread it. In Hindi, my mother always used to tell me this thing, कि विद्या जितनी बांटो उतनी बढ़ती है. That means the more you will spread the knowledge, it will increase in yourself also. Start writing. Branding will also happen. And ICI laws, advertisement through write-up. You write an article, contribute to ICI journal, ICSI journal, various platforms like Tax Guru, Taxman, whatever you like, Tax Sutra. People will recognize by your name, if not by face. I still remember when I came to Chennai for the first time to take a seminar, 2004 or 5 maybe. I can still remember those days when I was coming, I was slim also, handsome also. I will not say I'm not handsome today, but those days it was something different. This is very old picture, sir. So that means you have confessed. You are not seeing me, you are seeing the picture only. So those days what was happening, most of the people, when they came to the program, for the few minutes of the beginning, they were not listening to me. They were simply seeing me. And when this tea break happened, some of the senior chartered accountants came to me. Are you the same Kamal Garg who has written the book? Those days I was very surprised. Shall I take this as a compliment or a comment? I took this as a compliment. And today also what happened, when I came in the morning, so because something messy happened in the morning and I was not able to change, so I was looking like I'm not a speaker. So when I came here, nobody recognized me because they were on this impression. Or they were of the impression that I will come in some suit or tie like that. Better it is I'm not in suit or tie because it is quite hot climate and I am able to interact now. The point is, start writing something. 1 page, 2 page, 3 page, and at the end simply write, this article, this write-up is written by CA so-and-so. For any queries or suggestions, approach at email ID, phone number. Do not write for any consultancy, approach at. Consultancy will make it solicitation. But when you will write for any query suggestions, it will make it as a kind of write-up. And this way you will find some changes are happening. You must have heard the name Bimal Jain, GST expert. Bimal Jain ji is Bimal Jain because of this. We have traveled a lot. And he was having only one habit. He speaks very less. but he writes too much. And if you will write, like, many opportunities are there. Gift City is there. Have you heard about Gift City? Gift City, so many opportunities there. And for practicing into this Gift City area, you need not travel to Gujarat. Sitting in Chennai, you can do these services. Have you heard about Gem Portal? Enroll yourself in Gem Portal. Gem Portal, several tenders are coming. You can avail those services also. Number 3 important thing. How many of you know empanelment with ADB, Asian Development Bank? In Chennai, I found one thing very great, right from those days. When a person qualifies CA, in Chennai, nobody says you are a chartered accountant. They say you are the auditor. So when I came here and I took the first seminar, so people, how they were saying, Kamal Auditor is from Delhi. And I was thinking, and I would sign the audit report, how I became the auditor. So this is the branding, that CA means auditor. And that's why this question, how many of you know ADB empanelment? ADB means Asian Development Bank. Whenever time permits you, ASAP, on Google, simply search empanelment as consultant with the Asian Development Bank. Free of cost, enroll yourself. And then they will ask you some information, your name, your firm name, etc., etc. One information will be which country you want to serve. Entire Asia will be there. Even Pakistan will be there, Bangladesh will be there. At least you can place a tick. Who will go, but place a tick, because filtering will happen. Then what services? In services, there is procurement audit, due diligence, like Sir was telling, he does due diligence. And this due diligence happens at ADB level also. Just try and make a lookout, because all of us who are sitting here, at least before knowing ADB, everybody was saying no, nothing will happen. Who knows, something will happen from ADB. My father says only one thing, that you qualified CA, but whether you will remain CA. If I say in Hindi, how he says, कि आप CA बन गए हो, but क्या CA बने रहोगे? Now it's very, perceptive statement. You qualified CA, but whether you will be able to continue as a CA, because generally what happens, once we qualify, we say tata bye bye to the books. We leave the habit of studying. So you have to develop that habit of studying, and to develop that habit, only one thing is required, writing. Then you will write, you will study. And for this, now I will say you can take help of GPT. So give your thoughts to GPT. These are my thoughts, write a big paragraph. It will write a good paragraph. But you will say, write paragraph on your own, then there will be a problem. So whatever books you want to refer on auditing and accounting, financial reporting front, you can visit this website, collectmybook.in, and you may enjoy the reading. And thanks for this patience listening you gave me. Thank you very much.
On behalf of SIRC of ICA,
There. So I believe Madam will be circulating it. Vishnuji is from SIRC. PPT.
yes, sir, you said. We thank you, sir, for this enriching session. Good afternoon, everyone. Hope you have a good lunch. We have our third session on effective corporate governance and audit quality, NFRA over your shoulders, by our distinguished speaker, CA Bhavani Balasubramanian. Ma'am, I request you to occupy the dais, ma'am. I now request CA Anita, ma'am, to give the welcome address to the speaker.
Good afternoon, members. I take the privilege in introducing Madam Bhavani Balasubramanian. She is a chartered accountant and company secretary and had been a partner of Fraser & Ross and Deloitte with extensive experience in auditing in a variety of clients, including listed companies and multinationals in different industries in India and abroad. Madam is an independent director on the boards, audit committees, risk management committees, CSR committees of listed companies and public companies, chairperson of audit committee in one of these companies. She is currently a member of the governing council of the Madras Chamber of Commerce. She is an accredited leadership and diversity coach engaged in coaching senior and mid-management professionals. She has vast experience in audit training for over 2 decades. Around 15,000 professionals have been trained in audit methodology by her. She has held various positions. She is a chairperson of the Women's Business Council of the Madras Chamber of Commerce, an inviting member of the Center for Audit Quality of the Institute of Chartered Accountants of India, a member of the Academic Council of Shareholder University, Chennai, and many more. She has authored many books for ICAI, Practitioner's Guide to Audit of Small Entities, Implementation Guide to Risk-Based Audit of Financial Statements, Background Material on Auditing and Assurance Standards, Implementation Guide on Standard on Auditing using the work of internal auditors. She has received awards like Great Lakes Wonder Women Award for Invaluable Contribution in Management and Women Achiever Award from Chennai Citizens Forum. She is currently an invitee to the Audit and Assurance Board and a member of the Governing Council of the Madras Chamber of Commerce. With this, I would like to introduce Madam Bhavani Balasubramanian to the stage. Thank you.
To honor the presence, I request CA Anita to deliver the memento to our speaker, Bhavani Balasubramanian. With great respect, I request Bhavani Balasubramanian ma'am, CA to begin the session. Thanks.
Yeah. Even without a mic, I'm too clear, so there's no problem. At the outset, I'd like to thank Revati for curating this topic, especially for me. I thank the ICAI and the SIRC office bearers, in particular Babu Abraham sir, Preeti madam and Deepa for giving me this opportunity. When Revati called me and said, Madam, we are having a 2-day conclave and would you like to speak on something on audit trail? And she said, the session is for 2 hours. I said, what do you want me to speak for 2 hours on audit trail? And I said, why don't you give me a broader topic to cover? So then I asked her for the contents, and then I thought NAFRA was a material omission. So I said, why don't we talk something related to NAFRA, that is something which is a top of the mind important aspect for professionals like us. So I'm very happy with this topic because it gave me a lot of thought process, and I've tried to curate it. The first thing is it's not off the shelf. It's not a particular standard where you have to explain the paragraphs or something. This is some concept which I have tried to put together from the perspective of the accounting profession. And you should bear with me with a cluttered slide presentation. The idea being that these slides can be used by people for reference at a later point. But I have highlighted certain portions and I'm not going to talk through the entire text of the slides. I'm just going to cover highlights. So when you see the number of slides, please don't get overwhelmed. And I'm aware that we are post-lunch and I know how it would be for people post-lunch to listen to a topic like this. But I think we needed some energy before we go through this topic, so it was well positioned soon after lunch. Good governance. When we wanted to talk about corporate governance and audit quality, what Revati and me had in mind is good governance and what it means in today's context about what is good governance and what are the expectations from the stakeholders, including the regulators, on good governance, and how governance and audit quality could go hand in hand to improve the functioning of the corporate sector. So, just to start with the context on what is corporate governance, the fundamental principle of economic activity is that no man you transact will lose, then you shall not. That is the Arthashastra. It's not a quote from today. It is from the Arthashastra, where it was a very clear depiction of what corporate governance means for the entity, to the society, and to the stakeholders at large. So when you talk about the entity, all of us are familiar with the contents on the slide, and I'm not going to elaborate on it further. For the market, there are many regulators to regulate the behavior of corporates in the market and make sure that the market is smooth and there are no ripples. And NAFRA is one more younger regulator trying to achieve these objectives through the scope and work which they have been entrusted with. And we look at it, how it's going to achieve the objectives. When we talk about the key principles of corporate governance, all of us know the global corporate failures, and all of us are familiar with the various scrutinies which have happened over the last few years, I would say post-COVID, in the corporate scenario in India. Transparency, accountability, fairness and responsibility, protection of minority interests, governance through the supply chain, the director's responsibility and the statement which they make and the work which needs to go behind it. And all aspects of corporate governance would definitely be key principles which all the corporates in India are working towards and they've achieved. There are so many awards for corporate governance. There are role model companies which practice the best of governance in this country. What happens if there's a failure of corporate governance? It could be a board failure, it could be an ethical failure, a compliance failure, or a risk management failure. The question is, how do we spot them? And who is the first to spot these things? When I looked at what is the correlation, Revati has given me this topic, what is the correlation between corporate governance and that too as a foundation for quality financial reporting? It is simply making sure that information, when we talk about transparency, there should be no information asymmetry. Sharing of information should be what the internal stakeholders believe is important should reach the external stakeholders. That is transparency and symmetry of information which is conveyed. Minimizing earnings management, the actual and the real. Very often you find that quarterly results, when you go and interact with corporates, they are so much attuned to looking at the guidance which they have given, the earnings for the quarter, how do they vary and so on. And therefore, governance in making sure that there is consistency in principles, consistency in the way the accounting treatments happen quarter on quarter. And the last quarter is not something which tries to set the 3 quarters right, should be the aim. And enhanced transparency and accountability. There is a famous quote amongst accountants like us, when in doubt, disclose. Adopting the best industry practices. I'm sure many of us face the challenges when we talk about disclosures. When corporates say this is not necessary, this is not required under the standard, and then many of us have to quote industry practices to convince people to disclose certain aspects. The pushback is always when it comes to disclosing or when it comes to the auditor's report, because those are highlights which attracts the eye of any stakeholder. And therefore, the auditor has the additional responsibility to make sure that disclosures are fair and correct and reach the stakeholder to assist them for the decision making. So the key mechanisms, again, you are aware of these key mechanisms for corporate governance which influence financial reporting. You know the board of directors. We are talking about the disclosure of their experience. Today, diversity of knowledge in the board is given all the importance. Gone are the days where before 2013 came in, if you look at the pattern of how directors were on the boards, they were people who knew the companies for a long time and they were associated with the companies and they became directors and they continued for 10 years, starting from 2013, irrespective of the fact whether they were there before. And now, after the 10-year period is over, you're getting in the younger people who have had a larger scrutinized environment and who have understood those practices which are required today by the rule of law. And therefore, board practices are slowly undergoing the change to meet those requirements. Day in and day out, the new boards find this as a challenge because companies come back to say, no, we've been doing like this for years. Why do you want us to do this? But this is what the law requires today. This is how the regulators look at these aspects and look at the way the pronouncements are coming. So it is a bit of selling the regulation to people who have been familiar with this and who are stalwarts running the corporate sector. So these key mechanisms, the board of directors, the audit committees are expected to spend much more time and invest enough time and knowledge on each aspect which is brought to the audit committee. Internal controls, the control environment, we'll be going through those things in detail, but just to give you a flavor. just running through the SOP of the company and making sure that that is followed is not understanding the internal control environment. If you look at some good corporate practices, audit committees have special sessions on each of the key business processes. They have a 2-hour or a 1-hour session as part of their agenda, and they cover the important business aspects in the company to understand in detail how the process works, what is the system, what are the requirements, and so on. And audit committees spend time advising people what further to do. So that has been the role of the audit committees. Internal audit coverage. You're all well aware, if you've been used to an NBFC audit, the risk-based internal audit in NBFCs is an example role model of how risk assessment in the audit process has taken shape. And it is wonderful that people are able to implement it. And it is so exhaustive that I wish companies which are not under those regulations also start following a risk-based audit and taking a model from that. External auditing. You're all aware, industry knowledge, professional standards, and skepticism. If we have all this, then there's definitely an improved quality in terms of financial reporting, which would reduce errors and frauds, which would improve accuracy and reliability. Well, these are all aspects which we all know, so I've just run through it for more as a refresher. But when I tried to get a sense of how there is a correlation between corporate governance and quality of reporting, I looked at various surveys which are available, and I said I'm going to look at the underdeveloped country surveys to pick out some themes. I mean, the developed countries have their surveys and we all know how the themes would come out. So what is on the slide there is a result of looking at the surveys by listed firms in Egypt, 100 firms and 133 non-financial firms from 2016 to 21, which included 798 firms. When they say firms, it is entities, okay, which were looked at in terms of this correlation and the variables thereon. And then a study from the PLCs in Africa, again, for a decade, used the regression models and the SPSS versions 2.3. Then if you look at Jordanian companies, 167 companies, they had the survey with 160 questionnaires in the Amman Stock Exchange. And the themes which came out were very, very similar to those surveys in the developed countries. And the theme pointed out that regulatory agencies should ensure that the companies have competent and experienced directors in the boards. So what is India doing? There is this Institute of Directors which makes sure that there is this qualifying exam, and there are continuing education processes for directors. There are so many seminars, so many programs trying to encourage directors to attend these programs. The second point was stakeholders are to verify the appointment of non-executive directors so that grey directors do not form part of the board of these firms. Again, firms means entities. I've just picked up the wording from the survey. And therefore, there is this voting for people who get reappointed, and the resolution requirements are slightly higher, as you all know, for above 70 years of age. So the non-executive director should possess technical skills and the experience necessary to ensure high quality reporting. So there is again non-executive directors when they are selected. It is no longer a process of, yes, we know this person, the person can become a director. No. The board, because of the annual assessment process, in whatever form it is, they ensure that what are the skill gaps in the existing board members, and they look out for people who have got that expertise. Today, the top of the worry issue is whether the board has got enough capabilities on artificial intelligence. So boards are undergoing training for artificial intelligence on a war footing basis. More to be familiar to understand what is happening. At one stage, it was the ERP. Today, it is advanced to AI. So that is the correlation which we could make out, and I'm sure these would map to the objectives of any regulator in India. So the objective finally was to stall the convenience governance. That was what the survey said, that you cannot have a convenience governance in any corporate entity. So NAFRA, the regulator which was formed on October 1st, 2018, these are some of their quotes by the chairman, and I would believe that they are proclamations. they have an approach, a judicious approach to enforcement and supervision, and they have done a lot of work. And let me tell you all, thanks to this session, I have spent about 2 weeks reading each order of NAFRA pronounced line by line and understanding the themes and understanding where the regulator is coming from. So I'm sharing that benefit with you all during this session today. The functions of NAFRA, as laid out in the NAFRA Charter: setting standards, overseeing quality, investigating misconduct, strengthening investor confidence, and having an impact on audit committees. And they have done some work over the first quarter of this year, probably even March, to come out with some work which they have assigned to the audit committees through the interaction series. The purpose of NAFRA, as laid out in their rules: an independent watchdog, enhancing investor confidence and contributing to the stability of the financial system. Why NAFRA? There is never a good time for tough decisions. Leave alone the election, because it is a quote from Jairam Ramesh. But you have to pick courage and do it. Governance is about taking tough and even unpopular decisions. What has NAFRA done so far? 73 orders, 103 debarments, ranging on an average of 5 years for chartered accountants, 103 debarments. Audit quality reports, 7 reports have been issued. Financial quality reports, 4 of them. Inspection reports, 12. And consultation papers have been 11 papers which have been released. So this is the work which is all available in the website of NAFRA. And when you look at each of these assignments, I'm sure the professionals who have been responsible for running firms understand the difference between a financial reporting quality report and an inspection report and an audit quality report. I'm not going to elaborate on that. Having been a practice review director for 8 years and having done practice reviews for other countries in the Asia Pacific region, I can well understand and look at what NAFRA is seeing through the work done in these reports. So what NAFRA has come out with, the Auditor Audit Committee Interaction Series, they have released guidance, they plan to release guidance for stakeholders. There is collaboration with external auditors. There's impact on corporate oversight, and they are aiming at improving audit quality through these 4 steps. Financial reporting quality review. They aim to review work papers, they evaluate the sufficiency of quality control, and they perform other testing on audit, supervisory, and quality control procedures. It is somewhat similar to our peer review process, but a little more in detail. And as we go through examples, you'll understand the level of scrutiny which NAFRA aims at bringing about. What I have done is I've taken 3 themes from all these orders and reports and tried to work through the concept of corporate governance and audit quality, because both go hand in hand. That is why the Auditor Audit Committee Interaction Series. The auditor alone cannot do everything. You need the audit committee to bring about the initial discipline on which the auditor can bank his review on. That is the theme which is coming out by encouraging auditors and audit committee interaction. So I've picked 3 themes which are important from a governance and an audit quality point of view. Okay. And now starts my busy slides. The first one is on services provided and independence of the auditor. That is the first theme. So when we look at their observations, you find them on the screen. I'll give you a minute to read through them. And I'm going to talk only through the highlighted yellow wordings. So there is a lot of back and forth on what is prohibited services, because it is left a lot to judgment. And therefore, today, what was services which were allowed is slightly changing color and shape to being akin to prohibited services. You would have gone through umpty number of articles and case laws on this. And then they also would like to look at the non-audit fees, which is earned by the group entities to establish independence of the auditor. So, and then what is indirect service? If a network entity or if service is rendered to a subsidiary, although it doesn't have a direct prohibition under services, NAFRA is looking at it as an indirect means of service which is rendered and that which hampers the independence of the auditor. That is where the regulator is coming from, and that's why I have highlighted this for you all. See, they are talking about the 5 threats. They believe that the self-interest threat is there if you are engaged in other services. The self-review threat is there if you give an advisory service in relation to preparation of accounts. Although you're not actually preparing the accounts, if you give advisory services related to anything related to accounts, then that seems to be akin to self-review. Advocacy, we are all aware of that. Familiarity, that of course is nipped by the law of rotation, and the intimidation aspects. So they would like the auditor to make sure that these aspects are well addressed before any work is taken up. And then when you look at independence, more than the independence rules, the regulator is looking at independence of mind and independence of appearance. All of us know various situations. We've all read through the Code of Ethics, the old one and the revised one on independence and independence of mind, and I don't have to elaborate that further. So having this as a theme in all their reviews and having publicized these aspects to a large extent, which the profession and the corporate world has become aware, what has been the outcome? While there have been various regulations which have been talking about all this, but I see a perceptible outcome because of the aim to restore corporate, to restore audit quality and to make sure that corporate governance is at its highest in corporate sector. What has been the outcome? Separation of audit services from other services in a professional service firm. Now that seems to be the top priority. There's no question of trying to say, no, this will not get attracted by that provision. This can still be rendered. This was a position 7-8 years ago, but not now, not anymore. Whether it is in relation to the auditor or whether it's the audit committee approving the services, the outcome has been positive on this aspect. There is a careful screening of non-audit fees. It comes to the audit committee and the details are discussed, and therefore the audit committees look at this as an important aspect in relation to the audit fees, and this is given top priority. Sir, any doubts? Any doubts? Any questions? And submission of fee proposals to audit committees for prior approval. Today there is no question of rendering a service and then getting a post facto approval. You don't see that situation anymore. The audit committees, the companies and the auditors are very robust in making sure that this is followed, because most of the orders talk about any of the services which are post facto and not prior approval. This is a prime focus of the regulator. So this is the outcome on the first theme which I have taken up. The next one, lapses in investments. Investments is an important area where the regulator has focused and related it to the functioning of the company as well as the work of the auditor. And it directly relates to the governance practices of the board and the scrutiny by the auditors. So this again, I have picked out these paragraphs from the orders of various companies and tried to sanitize them. So you will have to bear with me because it's the exact wording which is given by the regulator. I have not tampered with it. So when you look at visible impairment indicators, the regulator says that the audit firm has ignored visible impairment indicators, and such as insolvency, permanent decline in market value, negative net worth of component entities, and this has resulted in not testing an impairment loss. So when I looked at this particular order and when I read the response by the firm says, although there is insolvency proceedings which were initiated, the project value was intact. There were credible investors who were prepared to invest. The port, which is going to come up as per the business plan, is going to be one of the most attractive ports. And the investor has been identified, and that investor is going to bid in the IBC. And the holding company would have 25 to 30% of the stake after the port comes up and that entity comes up in terms of its operations. This was the response, but that was not acceptable because that is more related to future events. And this was what resulted in this paragraph in the order. When you look at the next one, they have said that the auditors failed to obtain a board investment policy. Well, the arguments given was we cannot reproduce the entire company's documentation in our audit file. An investment policy is always available for review, and we have looked at the investment policy. But when you look at the context which they are talking about, what they are saying is what is the policy in relation to conversion of debentures into equity? What is the policy in terms of converting an advance to a debenture? What is the company's policy or what is the group's policy? Has that been looked at by the audit committee and whether that has been taken cognizance and whether the auditor has looked at that to make sure that the company has followed that policy for giving an opinion on investments. So when you look at what are the lacunae which they talk about in investments, verification of agreement to sell for enterprise value, question of recoverable amounts for investments, asking management to compute recoverable amounts, market cap and carrying value, including the loss for the year, whether that has resulted in an impairment. Projected cash flows are not looked at because it's not part of the audit file, or there is not a noting for this. The basis of arriving at impairment, which is not available in the work papers. And therefore, profits are inflated by not providing for impairment on investments. Well, this is an observation from the audit file. Let us look at the governance aspect of it. Whatever I called out now or whatever the regulator is looking for in the normal course should be part of the papers which come to the audit committee for scrutiny when they clear the financial statements. When we were youngsters, these things used to be copiously handled because there were only a handful of issues in each company and the documentation used to be in detail. Today, with the electronic age, with docking with different people and different people having different responsibilities, the aspect of assimilating all this rationale for decision making gets dissipated in a corporate environment. Today, I would congratulate the aspect of having a compliance officer in NBFCs and having compliance officers in the financial institution entities, which would really improve this kind of housekeeping and improve and real-time compliance. But the issue lies in the fact that these things have not been assimilated correctly and placed to people. It has been explained perhaps, or it is part of the agenda papers. The minutes, the purport of the discussions have not been captured in detail. Because the reason is we don't record the minutes of the meetings immediately. If you look at the draft minutes which comes, very often it comes after 3 weeks. Memory fades, right? Although there are recordings available today. But all these aspects which we spoke about should have been part of the governance process in the company. And today the auditor is there answering for this. Had they been part of the governance process, would it have reflected a better quality of audit? Because these documents would be available. And obviously, from the extract of the minutes, it would have come into the audit file. And there would have been conclusions drawn. I'm not saying this is the reason, but this is an important aspect which needs to be addressed. Because anything which is questionable on the auditor's work today is related to major decisions of governance which have been rightly taken perhaps, but not collated for the rationale which should be available for scrutiny. All right. So moving to the next aspect, there were deficiencies observed in the areas of use of valuation experts. This is another area for investments. In this case, they have said that 40% of the investments, there was only a one-line conclusion in the audit work papers to say, fair value per share exceeds carrying value, therefore there is no trigger for impairment. And that one-line conclusion is not acceptable as far as audit quality goes. Okay, they say the engagement team obtained the documentation and put it in the file for the sake of keeping documents. And no assessment was done for the impairment indicators. It was valued at cost without proper justification. In some cases, the valuation was done as per prior years because the last year's balance sheet was not available, or it was based on unaudited figures of the last year. There again, coming back to what was presented to the audit committee, for them to sign off first, after all, our signature comes after that. The first signature is by the board and the audit committee. So, how were these aspects addressed? Whenever accounts are approved, important account balances, important estimates, all these things, ever since I was an article clerk, the noting points in the resolution for clearing the accounts were so important. Right from fixed asset additions, right from valuation of investments, everything was documented in the board resolution. Although we were not allowed to see the minutes of the meetings, it was only the partner who was given the minutes book to write down the notes. But these things were copiously written down in the minutes. But today, most of the cases where accounts are approved, there are variances which is discussed, and the audit estimates and judgments are left to the auditor's presentation. I don't know whether people will agree with this, but that resolution should have had all these aspects discussed. Leave alone the year end. Each quarter, when these investments, which are 40%, which is material to the balance sheet, discussion about those investments, discussion about those company performances, and discussion about the fact that there is no impairment could have been concluded on a quarterly basis in the minutes. With the electronic era, what auditors do is get the electronic copy of the minutes and put it in the audit file. But then we are relying on the minutes being completely written. And this aspect could have been discussed quarter on quarter. I wouldn't say it is inappropriate or not required, because this is an important decision as far as a material figure to the balance sheet goes. When we look at post facto approval and prior approval, this is an aspect on investments which is really taken very easily. The dates, there again, because the housekeeping and the recording of transactions, people are not careful to see which should come in as prior approval or post facto approval. In fact, in the auditor interaction series on related party transactions, there's a question whether the company has instituted a platform and an electronic mechanism by which there is a trigger if a related party transaction has come up, that has to be approved by the audit committee before the transaction is put through. They are asking auditors to check whether the company has got that feature. That is one of the important questions in the audit committee auditor interaction series, because of the fact that they have found these approval issues having inconsistencies. So whenever you look at this, based on the review of quarterly investments and their values, and the year-end approval of investments could have been a good governance process. I'm not saying it was not there, but the quality of that process and the extensiveness of that documentation could have helped, the compliance of the visible compliance of governance, which is being established both in the corporate and the auditor relying on that documentation by the company. When we look at the management specialist, this was another aspect of review by the audit committee. This said that the management specialist, there are no engagement letters or written agreements, or there was nothing on the scope of the experts' work, and what is the methodology and the assumptions used. The firm's internal expert was only to understand the process of valuation done by an external expert. the next 2 slides are on that. As far as the management specialist goes, it is like saying a valuation by actuary. When LIC was the only insurance company, when we were being reviewed for practice review, when global people used to come and say, where have you assessed the actuary? People got furious because that was the only actuarial valuation entity in India, and it is so well known with its reputation. So all of us started writing, this company has got 75, because they said the 75 years of experience, they have all the knowledge and expertise in this, blah, blah. That used to be our justification of an expert. That is not enough anymore. They would like to know what is their scope of work, what is it they are testing, the persons employed on that particular assignment, whether they have the industry specialization, and whether the audit committee has gone through their work done in detail, first to assess, before giving the proposal for them to do the work, to assess the quality of the people, and then making sure that what is not covered by them is covered by the management. That is the extent of work which they expect the management to do, as well as the auditors to check. So there again, in an aspect which was so simple, yes, XYZ will do the valuation. That used to be the Asthana valuer. In that entire group, anything which comes, that person and that entity would be the valuers. And no questions asked, all of us accept that they are professional valuers. We never found anything wrong with that. And today somebody tells us that we have to go through all this. And there are paragraphs in the auditing standards which talk about this. Nothing is from the air. So whether we took those things for granted, we don't know. Or we didn't document the obvious, we don't know. Right? So, what should happen in terms of governance? Whenever an expert is employed, just like how an auditor's appointment or intern or any other, like your secretary, cost auditor, all these appointments, I guess the valuation experts' appointment should come to the audit committee, and they should look at the scope of work, and they should come back with their presentation for people to review and challenge those presentations. That is the level of governance which is expected from what I see from these orders. When you look at ECL is an area where you say, because of Ind AS, we have discounted it, taking an expected period of recovery for 3 years. This is discounted at this percentage, that is not accepted. Why that percentage? Why it has been applied? All the rationale has to be given by the management, that has to be approved by the committee if it's a material figure, and then the auditor has to have their own workings of this ECL and then come to a conclusion. This is just based on audit of estimates. It's the old standard. But the fact that if you have an automated program which runs the ECL, that is taken as final and sacrosanct. No. The assumptions. What were the assumptions taken? Whether it's only inflation, what were the other aspects taken? Whether there was a segregation of all the balances geography-wise, all that, to that extent the detail needs to be seen. So is the audit committee to spend time to look at all these aspects? Yes, matters of judgment. And therefore, to make sure that any material provision is really reflecting the true state of financial affairs. And that is where governance and reporting has to be taken care of. So these were the final lapses in reporting on investments across the orders. Because what they are saying is, if you have not looked at the impairment on investments, if your work papers were deficient, or if the board papers did not contain those things which you have looked at, why have you not questioned them? That these aspects of control in terms of governance, whether you have looked at it, what has happened, have the people charged with governance been reported on these aspects, and therefore a culmination of all factors on investments, why an adverse opinion has not been given, or how have the directors signed the financial statements as true and acceptable. So that's on the NAFRA guidance on ECL. Therefore, NAFRA came out with a guidance on 4 topics. ECL was one of them. And I have just picked out important questions from that guidance and given it to you in these slides. It will help you to prepare your presentations for audit committees and also help to anticipate what questions would come from the audit committee directors. This is one slide. It talks about appropriateness, changes and trends, examination of unusual movements, classification of different financial assets. Very often, we may take the main assets and look at the ECL, and the other balances could be given a go-by. Because it is Ind AS, we'll have to look at the class of assets one by one without omitting any of those. So changes in business terms, whether that affects the ECL, any changes in contracts. So then assessment of recoverability of balances, stratification, looking at the operating effectiveness of controls, and so on and so forth. And these are not just for the auditors. It is for those charged with governance, the audit committees as well. So what is the outcome of this? We've been having so many standards which were pronounced. And when auditing standards came, there was an effective date 2 years later. We had so many training programs. Then we came up at the end of 2 years to say, no, this is too much. We don't have the wherewithal for it, so we need implementation guides. So implementation guides came out. And then people started using some of them to the extent possible. Many people have endeavored to use them. And all these things have happened. But somewhere it has been left just to the profession, right? So the outcome of this audit committee series, if you look at it, what has happened in the boardrooms? Sitting on boards, I'm able to see what is happening. And this is a list of what happens. There is a discussion, detailed discussion on investment proposals. Valuation and legal requirements, copious material is produced to the board and there are discussions on each aspect. The approvals, whether the applicable laws have been met with, are being discussed. And the review of the net worth on an annual basis for unquoted investments, that comes up as a matter of clearance before the consolidated financials are approved. There is a careful understanding of ECL estimates. And the auditors are being asked whether they are happy with and comfortable on the carrying values of ECL. So this is at least a 15-20 minute discussion in boards today. So that is one of the outcomes of this interaction series. Within a short time of hardly 3-4 months, this seems to be the progress towards governance and quality of ECL and investments. Related party transactions. When related party transactions were there, for us, we understood it in those base years as a disclosure requirement, right? And then came the amendments in 2013 Act talking about arm's length and usual course of business. So keep that aside. Let's run through the observations. So when you look at the lapses in related party transactions, they spoke about audit evidence, arm's length, and ordinary course of business. They pointed out that the audit firm did not have a list of all related parties, and they did not check the ITRs, the directors, and the MPP1, and so on, and the KMP listing. If you look at our files, because we have a frame that it's a disclosure requirement, many of the audit work papers would have the final disclosure sheet in the balance sheet, in the related party work done area, and they would reference it to those aspects, right? So that is somewhat like a round reference. So whether we had made inquiries with the secretary as to how they have identified related parties, it starts from there. It's all in the related party standards. And how did they obtain this list? How did they work on this list? How did they get the approvals? How did they assess the rates and the prices? What is the basis? How is it compared to the income tax rates, and so on and so forth? This is all given in the related party standards. And for some reason, this has not been properly collated in the board papers or in the audit work papers. Because what happens, the approval, when it comes for approval, it is part of the agenda papers. And the approval happens either 1 year in advance, or it happens during a transaction during the year. At the year end, there is very often a resolution saying all related party transactions are at arm's length and usual course of business. And that is what gets repeated in the letter of representation. This is what happens in the governance process. I'm not saying it is not looked at for arm's length or on your normal course of business. No, that is all taken care, but it is lying somewhere else. The fact is we've had electronic, and the documentation is with different people, and collation of all that in one place and finally bringing it into the audit file as a voluminous set becomes a hassle. So this is what has happened in the governance process. And therefore the auditors, when they go through this whole thing, at the planning stage, interim and final, the documentation is fragmented in different places in the file. There isn't something which collates all this and runs through all the requirements of the standard. There's a checklist where it's a yes, no, not applicable on related parties. But beyond that, either the board papers or the work papers do not give a complete detail. That is the issue on related party transactions, in short. Yes, you can. That's what NAFRA wants us to see. It is from their orders. I was also surprised when I saw that, and that's why I put it here. The level of expectation seems to be that. I wanted to bring awareness in this, right? So we can't say, okay, give it to us in the representation that you will not part with it. You can't say that also. So what are we supposed to do? I'll come to some more further questions on this. I specifically picked that paragraph because I was also looking at it with a raised eyebrow. Okay. And looking at related party transactions, once a contract is there, and the last year we've gone through a process, it is only additional transactions every year, right? But as a governance discipline and as an audit process, it is expected that if there is a steep variation in that, we should look at it with a little more focused eye. And those were the examples there. The facility management services went up by 1,190%. I mean, percentages may not necessarily mean materially important figures, but here it seems to be that. And then revenue from the power division, which is again their own related entity, went up by 44.2%. So for those increases, what was the work performed, and how did we establish justification for that? Right. Again, this is an aspect which the audit committee, the CFO's presentation should have covered. Had it been covered, I don't think we would have turned a blind eye to this. I'm just trying to give the other perspective of these things, right? So the question is, it's not the auditor or the auditee. It is the transparency, the governance, and the process, the faithful process of approval of accounts and the financial transactions which need to be given this importance. Then just a certificate from the internal auditor saying all the provisions are complied. It's a 2-liner certificate, which is, and that is not acceptable. So they are talking about ordinary course and arm's length to a great extent in all the orders. And in one case, they have said that there were 3 bids, and all the 3 bids were filed in the audit work paper file to prove that there were 3 comparative bids. But what they expect is, what is the scrutiny on that? Either by the audit committee or by the auditors on saying of these 3 bids why this was chosen. It would have been discussed. It would have been thoroughly analyzed before the terms and conditions were frozen. That is real, accepted. But the fact is there is no evidence either in the company's documentation or in the auditor's documentation. And that is where the scrutiny seems to be aiming at. So, arm's length confirmation. What are the duties? Considering the appropriateness of the assertion, if we say it is in line with market value, it is in line with comparative prices, how far that assertion is right and what are the supports for those. Verifying the source of the data. where from they have obtained this data, and then evaluating the reasonableness of significant assumptions. So, standard comparison of rates, market prices is easy in trading transactions and normal administrative aspects. What about those which are proprietary in nature? Software, proprietary in nature on high-end technical equipments which are expensive, which are deployed. And for various reasons, the structuring would have been SPVs, and then another company holding these equipments, which is giving it out to many SPVs. That would be the structure of business. And therefore, when those rates and contracts are worked out, what are those factors which have been taken into account? It's not blindly a rate which is taken, no. While that would have been recorded as the rate, and it is at arm's length, that would be the conclusion. How is what is missing. The how would have been discussed. The how would have been arrived at. Any corporate entity would have its controls in terms of day-to-day operations, but that how could have not only quantitative factors, it could have qualitative factors. It would have established these entities for purpose of serving for the whole group because of the fact that they could have reliance on that dependency of that particular supply for the production. It could be timely service. It could be establishing a GSO for making sure that their financials for all the group companies are turned out on time. It could be a very well thought of business decision, and there should be a weightage for that in terms of qualitative factors. I don't know whether that would sell, but the fact is whether that has been recorded somewhere. If any business transaction would have been decided rates, contracts, they spent hell of a lot of time working out these contracts, all the contingencies, how the rates have been arrived at. People from the business finance spend so much of time working on this. But the question is how much of that is collated and kept in one place when it comes to the audit committee or the auditors for approval. So, how are we supporting governance and supporting audit quality reporting? Ordinary course of business. It could be transactions which are covered under the MOA, that's a simple thing. If it's unusual, is it too frequent? The converse may not be true. The size and the volume of the transaction, that seems to catch the eye of the regulator. I showed you the variances in the earlier slide. So the business purpose of the transaction. So is there a business purpose for the transaction? This is of supreme importance because of the Companies Act amendment in 2013. Risk of fraud in relation to related party. So 240 expects you to look at frauds whenever there is a risk, and if the related party transactions are huge in number, have we assessed the risk of fraud in related parties? And when you look at the governance side of it, whether the audit committee has asked these questions to people. Why this entity? Why not other entities? Why are you working only with your own group company? Are you working with other companies? If you look at RBI, when a group has an insurance agency and when these people are giving loans, RBI looks at the fact whether the insurance agency is recommended by this company when the loan is granted to a person is recommendatory with their own group company and other insurance agencies as well. They are very particular to make sure that there is that fairness and that choice for the person who's taking the advance to make their decision. So therefore, that kind of focus, is it there when related party transactions were granted? Very often what happens, related party transactions are discussed through the committees, not necessarily quarter on quarter. It is discussed any time it comes to the audit committees. It could get covered under the omnibus approval, although omnibus has to have very clearly little more specifics in the omnibus approval. That is the expectation. But nonetheless, many a time it comes to the auditor as a later on transaction. The auditor is not there in the scene when these transactions happen. So they rely heavily on the governance mechanism. And that governance mechanism should be supported by what they see when they come for the audit. Right? Otherwise, what is available as papers is what is the canvas on which the auditors can scrutinize. So NAFRA guidance on related party transactions. This is a very detailed guidance. So there again, I have picked out the questions which you can use as a ready referencer. Management processes, identification of relationships, internal control processes, management review of all shareholder agreements, and confirmation from promoters at the beginning of the year and at the end of the year. So these are some of the things which they expect the management to do in great detail. Okay, so the first thing I guess is the audit committee should spend time with the secretaries, and so also the auditors, to find out what is the mechanism of assimilation of related party transactions. Then management's identification of individuals, maintaining a database which I spoke about, how the finance, legal and secretarial teams coordinate to get this information complete. Completeness of related party transactions is an important aspect. Okay, we take the schedule given and then we do our audit work on that. So the question is, how is it complete? What have we done in terms of completeness of that? Both the audit committee and the auditor, there's no difference. So when you look at the risk assessment procedures, what had the auditor done for related party transactions? What is the guidance in terms of newly identified parties, significant relationships, evaluation for arm's length, and what is, if there is a variation between what the value which was proposed and the value finally which is there, that again, whether that has been scrutinized, both by audit committee. When we get these list of transactions for approval, if there was a limit sanction and it was not utilized, we ask that question in the audit committee as to why this was not utilized. You still want an approval. I mean, you keep it as a cushion, fine. If you have businesses, okay, you can have a reasonable buffer there to cover any transactions which would come in because you are in the same line of business with other group entities. But if something is not utilized in the previous year, then that question comes in. So similar questions whether auditors have asked is an aspect. So what is the outcome while there is an NAFRA guidance where there are so many orders talking about related parties? Okay, there was a recent court ruling that the auditor cannot be penalized for criminal proceedings for related party disclosures. So that was a high court ruling in one of the Western India courts. So that was one of the rulings about a month back. So what is the outcome of this related party guidance? There is detailed discussion in the audit committees on related party information. There is a lot of understanding on what is the regulatory requirements and disclosure, thanks to the SEBI requirements on the levels and the assurance required and the disclosure which has come out recently. SEBI has been very active on the disclosure over the past few years. I don't have to elaborate on that. All of you know that. And insisting on an independent verification and certification. Today, the audit committee wants an independent agency to do the audit of related party transactions, at least on an annual basis, in many companies on a quarterly basis. That is a process which has been put through after all this guidance has come. And a careful vigil on conflict of interest scenario. That is something which is getting supreme importance. Today, when somebody says, this particular company known to me or this particular entity has got all the capability to do this, the immediate question is, before we look at that, will there be a conflict of interest, whether we have examined? This seems to be a reflex question from board members. So to that extent, this guidance has helped in bringing to focus the governance aspect on related party transactions and therefore the role of auditors. There is also a guidance on taxation, but that's a fairly simpler guidance which talks about estimates, changes in previous estimation, and how contingent liabilities are disclosed on tax disputes. This is also a guidance given by NAFRA, but the three themes which I took up is what I covered earlier. Now, review of audit quality. Since all of us are auditors, I will rush through this in the interest of time. The general comment. This is a general comment on audit scrutiny. The nature and timing of procedures is inadequate as far as auditing standards go. The evidence obtained is insufficient, and significant matters and conclusions are not evident from the files. There is a standard general comment which comes out in most of the orders. 2-3 important aspects where it relates to governance. The regulator has said that the auditors have not communicated enough to those charged with governance. The expectation is that as the auditor progresses in their work, once they find issues, whether that is being communicated to people charged with governance. It is not enough if there is a communication at the year end. That seems to be the theme. What they have concluded in many reports is to say that the communication to those charged with governance is on date of signing the accounts, and that is no communication. You have not given enough time for them to act on it. And when you look at the paragraph on para 23, where matters which require to be communicated and the copy of the communication should be part of the audit file, they expect us to have a formal communication on all this. It's not a question of saying, I spoke to this audit committee chair, we discussed on the other day, no oral explanations are acceptable. It should be a copy of the minutes. If there was an oral discussion, there should be a copy of the minutes in the file to support communication to those charged with governance. Seeking information. We asked the management, is no explanation. Had in one order, they have said, had there been proper inquiries with those charged with governance and the regulator, an independent inquiry, the auditor would have got the information. So we are expected to interact with regulators if the situation arises to get the information to check. So the compliance is only limited to queries. Inquiries with management is not acceptable as a complete audit procedure. This is on communication with those charged with governance and seeking information from the management. This again relates to the corporate entities' processes and how to get the information. Risk of material misstatement. Only 2 risks are taken. One is revenue recognition and management override. No other risks are documented in the audit file. So the question is whether complaints, whistleblower complaints and RBI inspection reports in the case of NBFCs or any other regulators' inspection reports were considered for risks of material misstatements, whether these risks were reassessed. There again, looking at it from the governance side, whether the company has got a proper risk management system, whether the risk management committee meets, whether the risk management committee is also concerned with financial reporting and communication of information is an important governance aspect which the regulator expects to see from the entity as well as from the auditors. Walkthroughs. When it comes to walkthroughs, they have given all the failures seen in the walkthrough, because what they are saying in essence, what this whole slide means is that the SOP process has been either imported into the audit file, the company's process, and then there are tick marks to say these steps have been complied. The question is, has somebody looked at the credit appraisal process and looked at the lacuna thereof? Because later on, the advances have become bad. Okay? And then whether the question of these advances being prejudicial to the interest of the company has been looked at. And whether probing questions have been asked when we look at the SOPs. This is from the auditor's side. Today, audit committees are keen on having a separate session on the business process to understand the SOP, and they put forward questions to understand where are the gaps in the SOP processes, at least the major processes. They spend at least 1 hour every committee to look at this. So maybe that step in improving governance would help the auditors in terms of their audit quality. The question is, when we did walkthrough, have we selected convenient samples or outlier transactions have been selected? Is it only an outlier transaction which was selected and every compliance was done? So how is that walkthrough sample selected is an aspect to look at. Although we randomly pick 1 or 2 samples for walkthrough and then cover them. Test of controls, again, design, operating effectiveness, all of us are aware of all this. There's no specific need for us to elaborate on all those requirements. But what they are saying is, when audit committees look at processes, when they look at internal audit observations, when they look at the risk management presentations, do they also look at the control aspects? Do they question the control of the environments in which these business transactions operate. Are they making sure that approvals are with the authorities who are supposed to have these approvals? Is the delegation of authority in proper manner? The people who are approving transactions, are they the people who are empowered to do it? And any exceptions, are they coming forward in time for corrections or scrutiny to be made? Are these aspects being questioned by audit committees? Is another aspect which probably could help improve quality of test of controls in terms of auditors. Well, there are other aspects on EQCRs, which you can read later, on loans given. And there is a guidance series again on the audit plan and the strategy, where the audit committee is expected to ask the auditor about their audit strategy and plan, emerging areas of risk assessment. They are expected to also suggest some additional areas to be covered. This is all part of the auditing standards which were there even in the beginning on audit planning. It's nothing new. But this guidance series is trying to help people to use this as a referencer for conducting the audit committee proceedings. So similarly on internal controls, whether they discuss what are the audit procedures for opening balances, especially on rotational audits. And that covers the guidance series. So what is the outcome of this? The audit committee meetings in the last quarter could not finish on time. They extended for 3 hours, 4 hours. There are auditors who have complied with this guidance series. I'd like to just give you a flavor. There are people who have said that they have gone through this and they have come to the audit committee prepared. If the audit committee would ask questions, they were ready to answer their process and questions. So that was a longer process because questions were asked and they had responded and the secretary had to make copious minutes of this. There are firms who say that the guidance has come now, we are trying to come together as a firm to decide how we are going to proceed with this. So in the next year we will implement this. There are firms who have taken this utmost seriously and made a presentation on each of these aspects in the guidance series for the audit committee. In addition, they have answered these questionnaires line by line and produced that entire annexure to the audit committee for their review. So the extent of compliance with this guidance is in various stages. That's just for you to know what is happening. But from my sense, this seems to be much more compliance than what was seen before. In fact, the people who came up with this guidance series, they were doing a survey and they asked me for how this has been followed. And I gave them the feedback that there is a lot of awareness within a short time. But the only request from the profession is please don't push it to the last quarter of the year. If you would give it in the first quarter, then it would give time for the profession and the company to work to achieve a better quality of response, what is aimed at from this interaction. So when you look at professional skepticism, having looked at all this in terms of governance and in terms of audit quality, I just want to reflect back on professional skepticism. If you look at our A18 of Essay 200, it talks about evidence which contradicts, information that brings to question the reliability, and circumstances which suggest that more audit procedures are needed. Despite keeping eyes open for all this, if none of these three were cited during the audit, I have performed my normal procedures. So are we expected to document that there was no contrary evidence, there was nothing which raised a doubt as to whether there was a risk? Take the case of risk identification, risk assessment. Unless I believe there is a risk in this transaction in my planning process or in my subsequent reviews, how would I ever imagine a risk? So that's on professional skepticism. Whereas Revati made me looking over the shoulders when she gave this caption. So I went to the Webster-Merriam dictionary and looked at what this means. Being anxious or fearful about potential threats and consequences, often having a sense of paranoia or being hunted. It suggests a constant state of vigilance and worry of what is coming from behind. For some reason, the organizers have given me this heading and I was curious to look at what this means and what is the the shade between professional skepticism and looking over the shoulders. All right? So, our assumptions of the past as a profession, business decisions were not questioned by us. We used to say it's a business decision. Okay? Governance, nil or ill, was not for us to opine upon unless there were no records. Whatever were decisions made, as long as records were there, we went by the records. Business failure was always a management's responsibility. Transactions between entities in the group, we believed had a proper rationale. Okay? Estimates, if supported with valuations and workings, were acceptable. An investigator is one who sees through a microscope, whereas I see it through normal eyes, unless something looks weird. You'll all agree with me that these were the assumptions in which we did audits. You agree? Right? Now, expectations from the regulator. Documentation of all micro and macro processes followed in the audit is what is the expectation. I started with this. This was the evidence given. I've examined this. I've asked this question. Further evidence was given. And based on that evidence, I have changed my first conclusion. And this is the final decision which I have taken. So the track. Okay. Record of all formal and informal conversations on clients with audit issues. So the question is from the article clerk up to the top. Everything has to be documented. Display of skepticism in every audit process, an execution of every audit paragraph in the auditing standard. Literally each paragraph has to be taken and the skepticism angle has to be applied before we clear the audit process of all the essays without exception. Rationale for each audit test and explicit demonstration of the work done. You would say, my team prepared this work paper. No. That is, the work paper is prepared as a work paper. It's an audit work paper. It's not the client schedule. Okay, but kindly mark on that what was the work done. Otherwise, you've just collated figures. If in a hurry, the calculation was done and then it was cleared and that figure was taken, and you didn't get back with the archival and the other requirements on putting the tick mark summaries, that work paper is not sufficient. Challenging with questions on major items with the members, the audit team members and the client. Material balances did we discuss on each of them. Verification of corroborative and independent evidences for the work done with the supports. You need evidence for the evidences gathered, and that should be in the file. Okay? Partner and EQCR discussions documented in detail. Experts employed and consultations done clearly documented in accordance with the requirements of using an expert, para 1, 2, 3, 4, so on. Demonstration of compliance of laws, standards, guidances, and circulars. In short, the file should be a speaking audit file. This is not new, it's in SA 230. What has been claimed to have been done by way of audit procedures or what has been claimed to have been gathered as audit evidence should be attested and supported. No claim is that which is not supported in the work papers. So there is virtually no scope. This is what the regulator has opined. There's virtually no scope for purely oral submissions or discussions. Any oral representations they believe is an afterthought and was not the position during the time of audit. A professional who is awake in those that are asleep, Kathopanishads. I don't have to remind people about this sentence because all of us, this is the first sentence which we have learned when we took up our professional responsibilities. The unanswered questions. Is there any new ask? Is there anything which is not done in the audit? Okay. Is there anything which has been presumed? Is materiality absolute or relative? is not stating the obvious a gross negligence. Something which is obvious to me and the entire audit team, I have not written it explicitly, but that does it mean gross negligence? Okay. Is a missing signature in a work paper a crime? Is a valid explanation an afterthought? Okay. Is a work paper documenting minimum information at a point in time a sham? Should every work paper talk about a possible fraud? These are some unanswered questions. We cannot be mere consumers of good governance. We should be participants, accepted. We must be co-creators, and that is what the regulator is aiming. And we congratulate the regulator for having come out with such speaking orders and coming out with interaction series, bringing awareness to the audit committees and the boards in what they have achieved in such a short time of a quarter. And I'm sure their work is going to go more far and improve the governance of the reporting, the transparency, and the quality of audit. There's no doubt about it. The mission continues, the IndusInd Bank story. That's the latest for us. And I read in one of the articles that the NAFRA has requested to interact with the audit committee, which is a welcome step which they are taking. And we wish the regulator all success, and I'm sure as professionals, all of us would greatly benefit from seeing an improved corporate governance and that which gets reflected in the audit quality and our work papers. Thank you all for the patient hearing.
Privilege to welcome Mr. Pandian sir. Mr. Pandian sir's profile, everybody is aware of it. For somebody, I just want to say that Pandian sir is a senior advocate and former additional advocate general of Tamil Nadu. Pandian sir is a highly experienced and renowned Indian lawyer who was among the youngest in the bar to be designated as the senior advocate. He graduated from Dr. Ambedkar Law College, University of Madras, has 30 years of practice in the bar, with a core specialization in corporate law, merger and acquisition, insolvency, restructuring and tax laws. He practices extensively before Honorable NCLAT and Madras High Court. He was a partner of Subbaraya, Iyer and Padmanabhan and Ramamani, a highly reputed tax firm of late K.R. Ramamani, an eminent advocate of income tax. Mr. Arvindh Pandian served as Additional Advocate General of the Tamil Nadu government for almost 8 years, between March 2012 to March 2021. I welcome you, sir. Please take the stage. Floor is yours.
I also request, with respect to C. Anita ma'am, to give the memento to our speakers, Arvindh Pandian. Thank you, ma'am. I now, with great respect, invite Arvindh Pandian sir to begin the session. Thank you, sir.
To the office bearers of the Institute, Ms. Anita, chartered accountants gathered here, other professionals, it gives me immense pleasure to be here before this August gathering, I should say, that I saw the movie, so we do realize what an important, if not the most important profession this is, I presume, and I do acknowledge as lawyers. I always say as a joke, a person who tries very hard and tries to become a chartered accountant, finally if he gives up, he becomes a lawyer. And a person, and if they try hard and they can't become a lawyer, they become a politician. So, you may realize that both are true, because the best lawyers, Mr. Harish Salve was a chartered accountant. And regarding politicians, I don't need to say, you can count the numbers who have not been truly lawyers. So having said that, this is a remarkable dedication to, I think, your profession, the movie which was made. And I'm quite sure I also want to see, because it's more about the inspiration, not about what you achieve after. Everybody achieves different levels in the profession, whether it's a lawyer, chartered accountant, company secretary, architect, or I would say a doctor also. But that's left to the individual. But the struggles each one goes through in their respective professions, that's the one which has to be celebrated. Having said that, the topic given to me today is effective corporate governance. I mean, the three words are equivalent to an oxymoron. Corporate governance is supposed to be effective, but why do we call effective corporate governance itself? The topic itself kind of gave me a little bit of a very strange feeling that you can't presume that corporate governance should not be effective otherwise. So the thought process I would like you to take, we begin from that thought process itself, that we need an effective corporate governance. So that's not the topic, but that's a need of the hour. If you see, I'll be touching on various topics. So what is corporate? Everything has to be correct. That's what we presume as a general term, at least from what I try to understand. But it is on this that the businesses thrive or collapse. They try to, I would rather say, give an impression to the industry what kind of a company it is. The policies, the rules, the guidelines, or various other things, how a company tries to, or a corporate tries to show itself, so that everyone who as a stakeholder is dealing with it know that the managers are as such, the other shareholders or the top management and its customers are following a certain ethic or a flavor or a fabric of business which this company is standing out compared to others. So these policies and guidelines make up what, according to me, could be the term as corporate governance. There's no straitjacket formula because we only have more of code of conduct. If you don't follow this, you're not in corporate governance, if you go by SEBI or so. But what is corporate governance is not positive, but we are always negative, because even if you go by the definitions in various acts, we have qualificatory definitions. We don't have typically a very imaginative or a creative definition. We have only qualifying definitions. So corporate governance defines, if you see the institute says, the company secretary, is the application of best practices. That itself is what in your mind is best. It all depends on the, not just promoter, but every stakeholder in the entity. Compliance of law in true letter and spirit and adherence to ethical standards for effective management and distribution of wealth. Now that is the word I would like to say, the word distribution of wealth. Now that doesn't mean that people distribute the wealth. A person who is an ordinary shareholder like you and me, when we try to invest in a company, the so-called wealth creation which is made by the promoter or the management or the individual or a family, how far they are able to ensure that the surrounding corporate practices would result in a distribution of wealth and discharge of social responsibility. I think there was one session, the first session on CSR, we had to come to a stage of saying that you must contribute 4% to CSR. So we are always regulated, legislated, or kind of a stick-oriented formula where you will not do your CSR obligation, so I want you to ensure you spend CSR. But most of us know where this money goes anyway. It will only go to the same trust where the promoter has. If he's running a school for that same employee's welfare, it will go there. So it is taken a different color, but still, I would say, to be positive, it has seen a lot of percolation in terms of CSR also. This 4% has gone outside the group also in a lot of ways. So that's another important one. And for sustainable development of all stakeholders. This is what the Institute of Company Secretary calls this as the definition for CSR, a very good one also, I should say. But corporate governance as such, so far the company is concerned, you will see that a company is directed, controlled and held accountable. Again the word accountable you will find. So if you don't do certain thing, then you are held accountable, and if you don't do something, then you are not complying with what the meaning of corporate governance is. It establishes clear relationship between the company, its shareholders and stakeholders. If you go by SEBI, it gives you a particular manner how your corporate governance is supposed to be. I started my practice when the first report came out of the UK, London Stock Exchange, the Cadbury report, and then which became Mr. N.R. Narayanamurthy, as he then was, just when Infosys was breaking off, he was put by SEBI to head the corporate governance committee, and he gave a report. Now those days the reports you just like that cannot get because there was no Google. So you had to go buy it, read it, and then how theory developed. So at that moment, it was a conglomeration of all the best corporate practices from the developed world, and maybe additionally something like South Korea or Japan, taking the best practices we started. Until then, the word called corporate governance was not even heard, if I may say, because SEBI itself came only in 1992. So for it to mature itself, it took 6 years for us to hear this term. Now it was presumed that the board, quote unquote, will be packed with whoever is running the entity. It will be packed with only the family of that entity also if it is possible. And the outsiders who will, I won't use the word yes men, who will not question them if certain things also happen. It may be good also, it may be bad also. But the question of bad or good was not enough. We needed independent minds to see. But has it happened till 2013? That's another thing. Did the independent director concept still achieve it? That's another thing. So it is more about a mindset rather than regulation. Then promotes a culture of trust, transparency, responsibility and fairness. That's the asking for this term, corporate governance. Do you have fairness? The trust is supposed to be there. You will not put somebody on the board or somebody as a key management personnel or a KMP, whom we call, to say that I don't have trust on him. But after having put him there in a trustful position, does he really act in a fair manner? I have, at least in my profession as a lawyer, I find when people come to you, they come to you not asking whether you have to comply or not. They ask you, how do I sidestep? I won't use the word not comply. How am I able to kind of sidestep this issue? So we have to take very, very, very strange interpretations to ensure that this compliance is not right or is not required or not. Now that is not the job of a lawyer. Today at least we have moved away from that. People want to hear, most of the professionals who come to us, our clients, want to hear where is the line. Am I crossing it or not? If I am crossing it, am I cognizant of it or not? So if you see the word called transparency and fairness, it has increased tremendously. And that, I should say, more than in the large entities. Large meaning so large that we all know the names. More than them because they think they know everything. It is the startups who really have that philosophy. Youngsters, new entrepreneurs are looking at seeing to it, because if he has to get funds further from institutions, he has to be at a benchmark where his corporate governance, his credibility, his ethics are all kind of kept in such a way that the funds will follow him. Because what is seen for him is his fabric of ethics for the business, so that somebody is betting on him with money. This man is absolutely transparent, so the money of third parties which are in trust with us in a fiduciary capacity are invested in the right manner. So we are finding it's percolated down. Rather, it's now a down-up theory than a top-down theory. So people at the bottom are now looking at this corporate governance much better in private companies, which are small companies, compared to the large listed entities. Encourages long-term investment. Exactly what I was trying to also say. So if you do this, you really don't look at it as a short-term investment or my exit is in this form. No, you want to grow with the institution or you want to grow with the promoter. A strong governance framework ensures compliance, ethics and risk management. So the main objective of corporate governance. The corporate governance typically begins at the board level. Some of the boards, if you see, you will be able to find the best of the names. Some of the case studies I've got, you will be able to see. But majority of the cases failed because they failed to make the call. The independent directors or the persons who were not part of the promoter group, they knew what is happening. But it's again a dilemma. They have so much faith in the management that they feel that they're taking the right decision. But if the decision is right, but has ended up in a kind of a problem, it is these third-party directors who are blamed. Now, has he really kind of warned them or not? But then, does he have the expertise to warn is the second thing. I, as a lawyer, if I go on a board, now I won't be able to call the business decisions what they do. So I can't be there. I'm there for maybe a reason that there has to be an independent director. So you will find that whoever is there can always be blamed, or at the same time also, he will not get the benefit because it will be the promoter who will get the benefit if it does well. So either way, it's a kind of a, I would say, a very strange situation. Then effectiveness in the quality of leadership reflected in company performance. Accountability is being answerable to stakeholder, in line with global transparency standards. Now, one other question, if you see here, if we keep worrying about only satisfying this corporate governance standards, when do I do business becomes the answer which a promoter keeps asking. Look, do I need to only talk about business, or am I to only worry about corporate governance? So the thumb rule I kind of maintain is, the day you decide to take a loan from a bank or finance from a third party, and most importantly, any capital, whether it's equity or any other mezzanine capital from any institution, you are bound to follow all this. But if it's your money, your father's money, family money, and you don't want anybody, don't bother about this, because you are keeping it as a family asset. Company is alone there. Companies Act says certain compliances. Beyond that, there is no third party public money, because bank money is again public money. And I would rather say even a private equity also who come, they raise money from third party sources to invest here. So it's a very, very, very large owner's responsibility. If you don't take it and you have your own proprietary investment, fine. Keep it, the corporate governance at least, because you will find many of these family companies, quote unquote, have only 4 directors, husband, wife, children. Or even it will be husband and wife, 50-50, 90-10, all combinations. There I would not expect anybody to worry about corporate governance, because it's, instead of being a partnership firm or LLP, it is incorporated as a company. So there the question of global transparency standards. So corporate governance is at a much higher threshold depending upon the word called stakeholder which we saw. So the Narayana Murthy committee report which I mentioned, it brought out various success stories in all the, I would rather say, from the developed economy, but they kind of brought about these 3 terms: fairness, again, transparency, and ethical conduct. Now, ethical conduct again is a concept. What may be your Lakshman Rekha for ethics may not be for me. So it is more again about defining ourselves. It's not about being defined. Law defines anyway what is legal, illegal. It can't define what is a fabric of ethic. Ethic is what would be your own perception of the word called ethic. So I can't presume. So what is for Tatas may not be for X. What is for XYZ companies which we may put in the second level may not be for Y. So each one will have their own fabric. That I think should be something which we ourselves have to introspect. Corporate governance is about ethics in business, choosing right over wrong, especially in dilemmas involving conflicting interests. This conflicting interest is a very, very important concept. We do know many stories which happened in the US where the fund manager himself invests in entities where he would have been buying stock, or he has investments, or he buys over, he knows the promoter. So that conflict of relationship doesn't have to be just blood, in various other contexts happens. It is also very softly spoken in the Indian scenario also, because mutual fund managers have access to so much of capital. How they invest, nobody knows. So that has over a period of 20 years changed. How they can either buy, or how they can deal with it, or what quantum. Recently, you also found one large fund manager who was found that he was continuously investing huge amounts, also taking kickbacks. These all are the industry norms about investment. So what is right or wrong? That would be equivalent in my view to the term called legal or illegal. So the corporate governance reflects also the culture and mindset of management, not just compliance with law. Now these two again are two concepts. We are very, very good at compliance of law because we do not want to be on the other side of law. So we have chartered accountants, we have professionals, we have company secretaries, filings, disclosures. The moment some decision is taken, we know how it should be drafted, and within 24 hours informed to the stock exchange. There's a whole time network of flow of information to the regulators. But whether it is right or wrong becomes second. Mindset of management. We already know what the promoter likes, or the chairman likes, or the management likes, and you always tailor make the decision, or I would rather say nicely package it so well that look, the vision is possible to be achieved in this way. So you always know to come to a place you have either this route or this route. Which route to take is what matters. If I take this route, it's 80 feet road, but if I take this route, it comes through so much of cuts and turns, you will surely get at least one scratch on your vehicle. You will surely not want to take that. But 90% of the times professionals are asked, can you show me such a route? I have to reach the same place, but will I be able to also achieve through the small road what I want? this result X, Y, Z. I think that is where it's a huge combination of professionals of all of us where we have to call it to the promoters or the investors or whoever that you shouldn't look at this, look only at the 80 feet road. So not just the compliance of law. While it has evolved with new expectations and technologies, it remains a driving force for business. Yes, I was just mentioning, the amount of capital which can be attracted by virtue of corporate governance is huge. Because the day they know that you are like an Infosys or X or a Y or a company, this group, the perception is created, the flow of capital will be so much. So people will help you to drive your business in a better way. It also dictates how a company's board of directors helps cultivate success in meeting short-term and long-term goals. Because they are the drivers of, the board is the actual driver of corporate governance. Board members with the right tools for communication and corporate monitoring have a profound impact on their organizations. They are, according to me, I would say the traffic lights or whatever. If the board is the best traffic light, you will ensure that you will know when to go and when to stop. So the board plays a huge role. And on the board, if you have the right kind of person with a wider management, he is a nice, I would say, sounding board also to the promoters. It's a system by which companies are directed and controlled. I don't need to explain that, it's understood. Boards are responsible for governance of their companies. The shareholder role in governance is to appoint the directors and the auditors and to satisfy themselves that an appropriate governance structure is in place. Now, it's a, I would say, tripartite understanding. The shareholders, the board, and the auditor. All three play a combined role. Now, I have yet to see shareholders removing technically the chartered accountant or the auditor of the company, because 99.999% of the times an auditor is appointed only if he has a confidence of the, not just board, also the promoters. Now if he doesn't enjoy, he resigns and leaves. And in the last 10 years, and what is happening now, we know that auditors are resigning at the drop of a hat, do not want to sign to the extent. I do like the word what she mentioned, the two actors who came. You have the powerful signature, but the power is so much it can kind of blow on your face also. It really can blow on your face. The word called NFRA has created so much of stress on the profession that whether an auditor is really getting all the information, forget whether he knows or not, whether he's really getting all information becomes a huge challenge in my view. I've been telling privately my friends, as much as possible, don't sign balance sheets, sign anything else. Today it's becoming so much that the interpretation seems to be NFRA is against you. It is very tough for you to prove otherwise, and almost the cases, whatever I've seen, I'm yet to come across a clear case where a chartered accountant has come out of an NFRA proceeding. So that's a very important, I should say, a chance for the auditors to be part of the corporate governance where they must call if a situation does arise. Corporate governance is therefore about what the board of a company does and how it sets the value of the company. So the significance of corporate governance is it encompasses the rules, practices and processes that guide a company's operations. Whether publicly traded or not, a corporation is a complex enterprise. It's an interconnected web that weaves together the business itself, its executive leadership, the customers who buy its offerings, and the investors and financiers who provide the capital to make it all happen. Other key players include government bodies that impose guardrails and regulations, suppliers who provide the resources an organization needs to function, and communities affected by a company's operation. Good corporate governance aims to balance all these interests in a practical, fair and transparent manner. So whatever I read above is that last one line. A good corporate governance aims to balance all these interests in a practical, fair and transparent manner. I would give a huge, I would say, bias towards the first word, practical. But it always happens that if I am practical, I don't think I'll be able to comply with these regulations. If I am complying with the regulations, I won't be in a position to be fair. And if I am fair, can I be transparent? It's a kind of a wheel within wheel. It runs within itself. But how do you balance all this? That is where it's like the gray area, or what we call as a line of control. You should cross, but you're not knowing that you're gone on the Pakistani side. It's in that gray area itself you are there. You be outside, but technically you're not crossing the line. So corporate governance is as such a concept. It's like how you interpret the law as what we call. So the Companies Act and corporate governance, various provisions are there regarding corporate governance now under the Companies Act itself. Qualification for independent directors under 149(6) with the duties and guidelines, with the rules of 2014 also. There's a mandatory appointment of at least one women director on the board. Section 49 of the Companies Act, read with Rule 3 of the Companies Appointment and Qualification Rules. You have the Audit Committee, Nomination and Remuneration Committee. I'm just running through because these are all the provisions which are there. Shareholder, Stakeholders Relationship Committee, Vigil Mechanism under 177. Added to this, if you're a listed entity, the SEBI LODR, rights of shareholders, timely information, equitable treatment, role of stakeholders in corporate governance, disclosure and transparency, responsibilities of the board of directors. You will find this regulation more like a code. It doesn't say that a violation or so. LODR prescribes this, you are supposed to kind of ensure that these are visible at least. So that is more like a code as what you would like to achieve. So traits of a strong corporate governance is something which we have tried to define. The details vary across companies, geographies and industries, but the general traits for strong corporate governance, it's responsive, participatory and consensus oriented, efficient and effective, upholds the rule of law in applicable jurisdictions, advances equity and inclusiveness along with the company's strategic vision, ensuring that the corporation, quote unquote, does good while doing well and vice versa. It prioritizes transparency and accountability. You will find everywhere the word called transparency, fairness, ethics, and then the important word in the second bullet I would like you to kind of also take note is a word called responsive. You find various departments which are kind of shareholder investor agreements also. Some may not be very responsive. A good corporate governance is even a mail comes, any stakeholder is able to get some information or a response back. It need not be effectively what he wants, but is there a response? That's an important one as far as it is concerned. So how can organizations maintain the core tenets of good corporate governance while keeping up with the times? We keep changing on a daily basis. If the word called AI is coming in, I really am not going to look at that for corporate governance. Corporate governance is more here, not in the idiot box. How we think and not what AI thinks. So if we are able to kind of achieve our ethics, I think the system should take care of itself so far as reporting and disclosure is concerned. The business landscape being constantly evolved, which means that the principles of corporate governance are constantly also changing. And for that you need an effective corporate governance framework. So what is an effective corporate governance framework? My topic. Effective corporate governance framework. I started by saying a good corporate governance framework should support transparent and fair markets and the efficient allocation of resources. It will sound a bit economic, it will sound a bit business oriented, and it will also sound more of, I would say, codified disclosures or whatever. But it's a combination of all. It should be consistent with the rule of law. Now, rule of law is the necessity for a good, I would say, clear democracy. You have a rule, abide by it. There's no question of saying I can't comply with it. Then that's not rule of law. And support effective supervision and enforcement. So if LODR has given a certain disclosure, you are bound to follow. You can't say I can't be. Then don't be a listed entity. You have to come out of listing. So for some reason they're given. Or the industry of a particular class has to make a representation. This may not work out to us because regulators are there only to help the industry. They're not there to stop any kind of industry from running. So that is very much in regard to supervision and enforcement. Each of these is essential to strong corporate governance guidelines. Consider consistency with rule of law, number one, which encompasses legislation in the jurisdiction where a company does business, rules for listing on various exchanges, and regulations that impact worker rights and the environment. Because the employee is also one of the most important participant or a stakeholder in the corporate governance part, because but for him, the industry won't deliver its results. If you see the rule of law, I would say different jurisdictions you will find and different legislations. The same company will have subsidiaries in various jurisdictions. Let's say Singapore, let's say in Middle East, Dubai, or it will have in Europe somewhere. Now that company has to comply with that regulations. You can't say you won't, or you can't form a subsidiary there. But the Indian entity will know how to kind of manage its local, I would rather say, corporate governance as such here. It will not be able to do so in Singapore. It will not be able to do so in Europe. It's very tough. So the moment you have subsidiaries there, you will find that subsidiaries have gone rogue. What I mean rogue is you would have put two locals as directors there. He will not be bound by the Indian directions at all. He will say that I am a separate entity. You are only 100% of my shareholder if it's a wholly owned subsidiary. That doesn't mean that you can direct me to do whatever. I am a director of this company, so I take decisions. And then if the Indian company has become insolvent, it's tremendously tough to keep control over all these entities. I mean it even for the liquidator himself. It's very tough for them to control because the corporate governance of those entities are completely independent. He will say that I'll sell your shares. A new person may come and buy it. Either he will continue me as board, or they will try to change the board later with a new management. So the corporate governance in the last clause which I was just mentioning, encompassing legislation in jurisdictions, there it will change. It doesn't matter whether it's a private or a public. So these guardrails protect the rights of communities, customers, employees, shareholders and other parties. The first corporate governance principle helps ensure that a company is accountable and operates in a way that upholds these rights. So the rights and equitable treatment of shareholders and key ownership functions. Because these are the two facets of corporate governance regarding shareholder and key ownership functions. The owners of publicly traded companies, shareholders do more than reap the company's profits. There are also essential elements of corporate governance for many reasons, including participating and voting in general meetings. Now for a shareholder, these are the only three rights. He has a right to receive notice for meetings, he has a right to vote at the meetings, and a right to receive dividend. Other than these three, there is no other right to a shareholder under the Companies Act. So if he is to ensure that, that's corporate governance. Any of these rights are infringed, I won't say lost, that's not corporate governance, it's also violation of law. Electing and removing members of the board as well as an external auditor. Now director's appointment, auditor's appointment and removal, both are the power of a shareholder. So if a board does something and you don't like what the board does, shareholders can't pass a resolution and annul the transaction. Rather, they must change the board and ask a new board to decide what that decision is about. So the fundamental principle of corporate governance is shareholders do what they do, which is appointing directors, voting at meetings. Board does what it does, that is managing and running the business. Both can't interchange. So that's been in many cases where when certain property was thought to be sold by the board of directors, the shareholders will say, I've got 80%, and they will pass a resolution to undo the property sale resolution. Courts say, sorry, you are a shareholder. You don't like your director, you change the director and then let him decide on whether to sell or not. But at the moment, it's the board's decision in their wisdom and discretion to sell. That is their corporate governance freedom because they run the business. Shareholders don't run business. You only elect the management. You stop there. So that's a very important principle of, you would say, the Chinese wall being very clear between what is a shareholder right versus what is a board right. Approving or participating in fundamental corporate decisions like authorization of additional shares or amendment to governing documents. This also, the decision to amend or so will be first done by the board, placed only for a yes or a no. Maybe amendments will be done whatever he wants. Additional shares, yes, you want to give, you give. You don't want to give, don't give. So the yes or no alone is shareholders. But the decision whether to say yes or no becomes the board's. That's the corporate governance. You will find that each one kind of challenge each one's space but control each other's space also. The second principle behind good corporate governance helps the rights play out equally for all shareholders regardless of class. Now, I don't want to get into specifics. You have a preference shareholder, you have in preference shareholders are various classes apart from equity shareholder. So if you are taking some decision, ensure that ratably everyone's interest is protected. That's the fundamental principle of corporate governance vis-a-vis shareholders. If you try to say that we do have, Companies Act does give disproportionate voting rights, but that's because at the inception itself you say this is going to be his voting right, disproportionate from the other group. But having done that, you could put a kind of ethical question back to me. If the promoter, or not the promoter, some other group is brought about by giving because he's going to put in a large amount of capital, so he needs these rights, then that's a justified right. But should you go back to the shareholders to ask for rights issue and then do it? Now that's a management decision. It's like saying that you have the best fund in the world who come to invest, which will add a huge flavor to you, that your stature in the industry itself goes so high because people like these are investing. Will you then go about giving it to local shareholders as a rights issue? Well, that becomes a dilemma. Most of the time they move only towards an investor because it's actually lifting, and it's indirectly also lifting shareholder value. So the corporate governance, how you choose, is from the philosophy of investment also. Institutional investors, stock market and other intermediaries, these people also play a huge, I would rather say, if not play, they kind of indirectly support these principles because they will not encourage you. You will not get value creation. You will not get the traction also unless you are able to achieve what an unless there are institutional investors in a good, I would stock, the management has not got itself, I would say, vindicated. If it's a good company also, but if it's only promoter, but there's no liquidity, there's no institutional money. Institutional money is nothing but public money. So these intermediaries also play a huge role. You will find that the immediate relationship between the company that issues shares and investors who buy them is just one aspect of capital market. Several intermediaries keep the gear turning. Stock exchanges and brokers connect buyers and sellers, while institutional investors buy, sell and manage stocks for other parties. Credit rating agencies, analysts and proxy advisors deliver guidance throughout the process. All these parties need oversight for fair and effective functioning. Well, the proxy advisors have just started in the last few years to call out which companies kind of corporately governed, which is not, what is a problem in their company or in their disclosures. That's really started like the West. But it's a matter of time before, that's why they say today running a listed company itself is a business. Leave apart the company doing its business, the compliances, the disclosures, and the accountability, and I would also say the liability in case they violate. So that itself is a huge business. So the proxy advisors, the other analysts are the ones who will call about whether you are really worth as an investment. That decides on what your PE also will be, apart from the industry PE. Imagine if a conflict of interest were unchecked in any of these areas. It is happening. It is happening. Unchecked means it's not come out. The moment it comes out, then are you willing to call it as a conflict? Say a personal connection among top leadership leads to a favorable treatment of one company over others. Brokers might promote one company's stock over others, and the clients of institutional investors might not get the best mix of companies in their own portfolio. Meanwhile, investors wouldn't be able to trust the objectivity of an analyst report or credit rating. Now, these are all happening in the market. So you know very well when the markets are really going down, or let's say that a COVID announcement which happened, it is a LIC which comes in to support the whole market. LIC is nothing but institution, quote unquote, on literal meaning, but public money. So the moment any institution comes, apart from LIC, is also public money. So if these institutions have to come and support you, then you will find that it is I would rather use the word the negative information or a positive information, and then based on that the brokers and who all consider this event as a corporate governance event or not. That is what leads to finally whether the stock is really getting its value or not. This is if it's a listed company I'm talking about, because corporate governance predominantly now towards only listed entities. For that reason, considering those with an interest in the company is foundational element of corporate governance. It's the oil that keeps the engine parts running smoothly. So corporate governance is like a fuel, in my view. Disclosure and transparency. So if a decision affects the material health of a publicly traded company, boards must promptly inform investors. The fourth principle of corporate governance requires clear and transparent communication with all shareholders and stakeholders. It's a fundamental principle. I don't even need to explain it. Take the appointment of a new CEO, for example. A publicly traded company can't just slip a new CEO into such an important and fiduciary responsible position without solid explanation, rationale and context. Now, all these are theory. When somebody comes, It's presumed that this person comes with some kind of qualification to run that business. It's presumed that he has the experience also to come and turn around this business or drive this business which is going well. But still, whether it is achieved or not is another principle. Because if every business does well, the word called loss doesn't have an impact at all. When choosing new leadership, companies should follow a structured process that addresses the recruitment-related elements of corporate governance, succession planning, conducting the appropriate due diligence, considering diversity and representation in the recruitment process, and choosing leaders who fit the skills, needs of the board, marketplace, and corporate strategy while providing visibility into the entire process. Now, I didn't stop and read because please read the whole thing again when you have time and apply it to the Tata Mistry case. Well, I'll be coming to it. When Mistry was chosen, before that, the Tatas really went to town, really tom-tomming, saying that we're going to get a very professional CEO. They appointed an Englishman, and Ratan Tata, I think, as part of the search committee, they went around the world and could find only again one more Parsi who's a larger shareholder. They're not able to identify anybody throughout the world. Now, is this the method of recruitment which you read here? No. And after that, God forbid, the man even died. So you went around the world saying that Tatas are so good in corporate governance that we'll find the best of the person. Let's be happy, at least we now have a South Indian there sitting. So you have to give credit from that angle. But when they really wanted to have leadership, there was no corporate governance. So they understood that, and they understood that today if they don't follow what they spoke, then the industry is not going to respect. So they were constrained to get an insider thereafter who doesn't fall under the category of whatever they had as an unwritten rule to get into the management. And by then, the two groups had also fought. So there was no necessity to give him also. So that, I think, is where we have a hypocritic method of recruitment called transparency in our system when we go for top management. This is a very important aspect of, I would only use the word Indian culture. I do not know about the West. They do have it, but it will be in different ways which we can't even imagine. It will be there. But today we are talking only about our corporate governance. Are we following all these principles while kind of choosing the leadership of the entity? Such thoughtfulness and transparency engender confidence, showing shareholders a company has nothing to hide. They also demonstrate the company's commitment to protecting shareholder interest and willingness to be held accountable. That's a very important aspect. So the responsibilities of the board. The fifth principle of corporate governance ensures the board structure supports effective oversight and accountability so directors can exercise objective and independent judgment, oversee risk and monitor managerial performance, in effect, perform their fiduciary duties. Now, it's a fact that what we call as in law, if you see in company law, we have this alter ego doctrine. The alter ego is who is the brain behind the company. There can be only one brain behind the company because of body you can't live with two brains. The same way a company cannot have two brains. So one brain is the actual figure, actual head. The actual investor, the most important person will be affected by a positive or a negativity of the decision making, and that person is called in the principle of alter ego that he is the one, whether he is on the board or not, as alter ego. Now that person ensures that who constitutes the board. And when he is bringing a board, is he bringing a wide diversity? Yes, he will bring a wide diversity, but will it bring about a wide decision making process? Means that is where the questionability arises. So there's diversity which we are achieving, but decision making are we achieving? That is something which all of us have to answer. The responsibility of the board, normally about the meetings. The second bullet alone I will touch upon and just go fast because time is also short. Conflict of interest. The earlier Companies Act did not have the term called conflict of interest. We only had what is called interested directors, disclosure, and that disclosure having been made, whether you can vote at the meeting or not. The Companies Act 2013 brought about section 166, which codified duties of directors. Now that's the most important, I would say, section of the whole company which I like in the 2013 Act. Everything is a concept which has come from earlier. So you can't make money at the expense of shareholders, you can't indirectly do anything which is against interest. So it's a very, very wide section which will almost touch upon ethics and not law. What we call the word fiduciary, which has been defined for 100 years by the Englishman, The fiduciary is a concept which is required for a partner, trustee, and a director under the Partnership Act, Indian Trust Act. So a trustee is supposed to have all these three, which includes the director also, because Section 88 of the Trust Act also applies to corporate governance. We didn't have a similar equivalent of Section 88 of Trust Act inside the Companies Act. That came about in the it was not there in the 1956 Act, it came in the 2013 Act. I would request you that if you're reading corporate governance, it doesn't matter whether you're a public company, private company, one-man company, small company, Companies Act applies for everyone, and this 166 is a huge concept, because people, as I was telling you, if it's a family company, we all think that being there, I can do anything what I want. No, but actually speaking, if I compete with my own company, so I can't say that I run a company with a particular business, but I run a rival business. No, nowadays it's prohibited. Promoters think that company is their own. No, company is a separate entity. You only own share capital there. You are entitled to dividend from there, or a salary if you want to work, but the profit is that of the company. We are yet to come out of that dream, I should say, that the company is not mine. No promoter is willing to let it go when it goes into IBC. No, they think it's my company. They say, you are only a shareholder. The law allows you to be a director there. That doesn't mean, the fundamental principle you would have learned in company law also is the property of the company is never the property of the shareholder. That is the fundamental principle in company law which we come with. But it will not be for any of us when we tell the promoter. It is his company is what we talk about. That is the fundamental, I would say, contradiction. What is in law is not in practice, particularly in our country. Whereas in the West, imagine 3 times a person who gave insolvency is the President of the United States. Because the moment he gives, the assets are immediately taken, business is restructured, sold. Then he comes to a second business. Again insolvency, gives it, sells it, comes to the third business. The third business trumped ours, and now he's kind of president. Their system is able to accept it, but we won't be able to. Because the immediate thing is, right from the driver's money to our servant at the house is all paid by the company, which is not the case in the West. So we have a lot of fundamental cultural problems with us, with a word called corporate governance. Sustainability and resilience, ensuring that a company can withstand the winds of change and thrive well into the future involves a great deal of decision making and risk management. There's an unwritten, I would say, kind of a survey done where the biggest of the groups in the country, many of the children are not coming into the business because they feel it's very tough to run. Most of them have started controlling family offices and are investing in other businesses. Whatever money has come as wealth from their grandfather or father, they've taken that money and they're rather doing investment business than running their own business. They feel that let me put professionals, it's already a well-oiled industry, I am not there to run it, there's already a system running it, why should I go and disturb? Instead of going and driving it in new ways, not all, but a predominant majority have started, quote unquote, forming these family offices, and the wealth, what they have, 5,000 crores or 10,000 crores, are running behind startups, other investments, or also making investment in stocks, stocks also, and entering the industry. So you will find that there's a contradiction. Otherwise, earlier we'll say only the businessman, son, grandchild, everybody could run that business. If they are not good, what I mean not good, I'm sorry, not using the word, if they feel that they don't have a flair for it, predominantly they are walking away. They also say, for working for 8% of the profit or 10% of the profit, I'm not there, I want to make 100x, 20x, 30x. The number of x's are increasing. So for that, you will find that the company cannot withstand change. Company cannot withstand change because first of all, to survive itself becomes a problem. And then only comes change. Today, many industries have gone away. Industries, I mean, not just individual industries. The industry as a whole has really had problems. When that happens, they have the fear, should I be there or not? So sustain it because there's 5,000 employees, I have more than 5,000 crores of loans, these have to be oiled. So let that continue to run as long as it's running. I will ensure that I'm outside. One example is climate change and the transition to net zero operations. That's a huge letdown if you see. But the best one. Why are we talking about climate restrictions? Because the West doesn't want this industry in their place, because they feel that these industries, though giving money, is spoiling their climate and also their health. Everything boils down to me, in my view, only for this one word called humanity. If you are not able to achieve this, how much ever money you make, it's of no use. Absolutely, and I don't speak it, I try my best to also live it. Until you take care of yourself, you will not be in a position to take care of your clients. And to tell you, the professionals are the first dispensable commodity. The day you are not well, even for one day, the client is willing to look at somebody else for that view because he thinks that he has the problem ready on hand. He needs a solution at that moment. So your fever or you being in hospital really doesn't matter. He has the sympathies. He'll even pay your bills. He'll even take care of you, but he needs it. And I call in my profession, the senior counsel like me are the most dispensable because at least a junior lawyer is 24 hours with him preparing papers. We senior counsel are engaged only by lawyers. So if I am not there, he will immediately jump the next day morning to another one. So that leads to a cycle where if I am not there, the reason is health. Why health? Because whatever is pollution or my own health reason that I have not taken care of myself. So if we have not taken care of ourselves, look at a country which is not taking care of itself or industry is not taking care. So we always call pollution laws are too tight. Environmental law has become the reason for not industry developing. I would say it's good. If you can't keep an industry which is going to spoil industry, it's good. Look at Scandinavian countries. Look at America doesn't even want to touch its soil. It's saying whenever it wants, I'll open my 100-year-old after Alaska. Let Russia, everybody sell. So each one has got their own philosophy. I may be wrong, I may be right. But the point is how to find a balance. Industry development also has to be there. I belong to a corporate law practitioner. So I've earned my money, I've earned my fame, I've earned my name, I've earned everything only from corporate law. But that doesn't mean it has to be at the expense of humanity. How best can you sustain it? There was one industry down south. Suddenly one day the government closed it. 5,000 employees went jobless. 10,000 traders went without being able to supply. Till now we have not opened it. What reason? It could be a political reason, it could be pollution reason, whatever. But there is some reason. So is there right or wrong is always a kind of a dilemma which we always keep thinking. I say, and I would like to call that environment is one of the important things which is equivalent to corporate law is for a corporate governance is for an artificial person. But environment law is for a living person. Look at it from that angle. So if we are not able to look after ourselves and our children and I would say the posterity to come, we are living a very bad world. I'm not speaking on environmental law because I don't like the environmentalists basically. I'll tell that also because they call out too much. They completely want it cut. Industry should not develop. No, that's not it. At the same time, are we able to sustain with the best of the laws which is possible? So, and within a company is good corporate governance, enabling sound risk management, within the great capital market, disclosing material data in a consistent, comparable and reliable way ensures that investors, exchanges and advisors have the information they need for smart decisions. Then what are the pillars upholding the corporate governance structure? Do I have another 5 minutes? I'll try to wind up. So I'm just trying to show the board which we saw, the shareholders, who are all the concepts, the executive leadership, the internal controls. Understanding effective governance is essential, but many organizations equally wonder what is the bad corporate governance. Failing to follow 6 principles of corporate governance which we saw already, and any misstep or unethical practice can ruin a business in a heartbeat in a world of fast-paced news. And then consequences of bad corporate governance, well, financial losses, loss of stakeholder trust, reputational damage, operational inefficiencies, increased risk, lower stock performance if listed, and regulatory penalties. I have given case studies. I'll leave the presentation to the organizers. The case studies I've touched is Kingfisher Airlines. I've kind of explained it. I don't want to tell it. That's one such case very clearly. The Tata Mistry dispute. Tata Mistry dispute is more on also shareholder rights, not just corporate governance, because the shareholders had appointed Mr. Mistry, but Tata and Mistry couldn't see each other's face. That led to this. Yes Bank, that's one which we saw, completely went down. Now SBI has only brought it up. Jet Airways, another one, again. Then this is an interesting one of Delaware, where Supreme Court's decision in Marchand versus Barnhill. It's a 2019 case. This alone, I'll just touch it. Last line alone, the Delaware Supreme Court's decision clarified that directors' duties to oversee the company's compliances with legal obligations and risks associated with its business operations. Nothing really new is what we will think. But the liabilities for not doing this is very high there. We don't have the word called damages or compensation so easily put. Though I do find it in NFRA now. Auditors are getting crores and crores of penalties now. This case law is one which I would like you to read it later. Unaddressed aspects of corporate governance, there are too many yes men. It doesn't matter in which position you are, including us. I have to say it because I need to keep the judge in the proper mind, so to explain the case. Yes, my lord is the normal term which we use. I can't say no, my lord also. I can't even use the word no. I'll have to say yes, my lord, and again I have to go back around and come back to the same place and explain to him the same thing. The moment I use word no, the person who's sitting there is also a human being gone. So for me, if it is such, it will not have an impact, but rather I'm doing it for a client's sake. But here, the people who are supposed to not say yes, the impact on the other stakeholders is going to be huge. Then who are the yes men? The independent directors, of course. Then also the remuneration packages, and then the executive director, is he really calling this management? Flower directors, that's a very interesting concept. Historically, the independent directors in England were called as flower directors. They only decorate the board. That's why they're called flower directors. So if you are supposed to get the best of the names, everybody likes to have the best of the board, they will say. You will try to get the best CA, you will try to get the best MBA, you will get a Harvard, you will get a XYZ from Oxford or Cambridge. Everybody is packed. It's like as if you are running a university. For a university, you get teachers and professors from everywhere. Yes, that's best academics because they need to teach. But you can't have an academic sitting on a board just based on the qualification. What is his experience? So I will put it last sentence. The worst of the academics have been the best of the lawyers in my profession. If I just pass, it's fine for me. But what I do after I pass is what matters. Am I able to really come up to my own, I won't use the word creative, slight lateral thinking to ensure that I deliver to the client. That is what matters. The gold medal doesn't matter. The gold medal stops at the college or the CA or the law college or wherever. But after that is where the actual jungle is. So these flower directors, if you have on the board, English law says no. It is understood that the board is playing a crucial role, but these flower directors are only there to decorate, but they will not be able to give you results. So therefore, I just hope that I was able to maybe add some value to the topic called corporate governance. In case of any, I won't use the word questions, you would like to ask me or give a context for another 1 minute I can take for a moment, and then thank you for the opportunity of having given me.